Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, we spend so much time trying to copy the winners, trying to follow in the footsteps of the greats. But what if we're looking in the wrong place? What if the real secrets, the most powerful lessons, aren't in their successes, but in their absolute most spectacular failures? Yeah, that's what we're going to get into today. So, our roadmap for this whole thing comes from a fantastic book by Michael Batnick called Big Mistakes. And it does exactly what it says on the tin. It digs into the absolute worst investments made by some of the smartest people in the game. It's basically a masterclass in what not to do. You know what's funny? Confucius nailed this thousands of years ago. He said you can learn wisdom in 3 ways. First, reflection, that's the noble way. Second, imitation, that's the easy way. And third, experience, which he called the bitterest. And that's exactly what we're going to do. We're going to take that third path, but with a twist. We're going to learn from the bitter, incredibly expensive mistakes of others, so hopefully we don't have to make them ourselves. So yeah, let's just flip this whole idea on its head. What if the thing that makes these investing legends legendary isn't that they were always right? What if it's how they handled being spectacularly, catastrophically wrong? That's the idea we're going to chase down. All right, first up, we're diving into what I call the trap of genius. This is a story that proves without a doubt that being the smartest person in the room, well, it can actually be the most dangerous thing in the world. Okay, so let me introduce you to a firm called Long-Term Capital Management, or LTCM for short. And look, this wasn't just some hedge fund. This was like the financial equivalent of the Avengers, a literal dream team of the most brilliant minds on the entire planet. I mean, just look at this roster. You've got John Merriweather, a legendary trader. You've got not 1, but 2 Nobel Prize winners in economics, a former vice chairman of the U.S. Fed. And on top of that, just a small army of PhDs from places like MIT and Harvard. These guys weren't just confident, they genuinely believed they had cracked the code. They thought they had built a machine that had, for all intents and purposes, solved the problem of risk. And that level of confidence, well, it led them to this. A staggering $1.25 trillion in open positions. Now, to put that into perspective, this one little hedge fund had a financial footprint bigger than the entire economy of many countries. They were playing with an unbelievable amount of fire, and they were absolutely convinced their genius made them fireproof. And right here, this is the moment that their perfect, beautiful mathematical models smashed headfirst into messy, unpredictable reality. You see, their super sophisticated models predicted that on a really bad day, they might lose about 35 million bucks. But on a single day in 1998, they lost 553 million, over $500 million in one day. Turns out their formulas couldn't account for what Isaac Newton once called the madness of the people. And the bleeding didn't stop. It was just catastrophic. In just 1 month, August of 1998, the fund hemorrhaged almost $2 billion. It's like their genius had built this incredible, unsinkable ship, but they'd completely forgotten to install any lifeboats for when the perfect storm hit. And it did. Nassim Taleb, the author of The Black Swan, just hits the nail on the head with this. He said they made absolutely no allowance for the possibility of their not understanding markets and their methods being wrong. And that's it, right there. Their own intelligence became their biggest blind spot. They were so sure they were right that the idea that they could be fundamentally completely wrong, it just wasn't even a possibility they could entertain. Okay, so if being a genius isn't enough to save you, what about passion? This next story has nothing to do with IQ and everything to do with emotion. It's about that feeling of falling so deeply in love with an idea that you just can't see that it's dragging you straight to the bottom. This is the peril of passion. And for this one, our case study is somebody you'd never expect, the one and only Mark Twain. I mean, an absolute genius with words, one of the greatest writers ever. But when it came to investing, let's just say he was a magnet for bad ideas. Total fool's gold. Get this. He poured what would be, in today's money, about $5 million into a single invention. Just one. He was completely convinced it was going to change the world. And in a way, he was right. It changed his world by completely ruining him. You know that old saying, the first law of holes? If you find yourself in one, stop digging. Well, Mark Twain's big mistake was he just kept digging. He invested in this ridiculously complex machine called the Page typesetter. And when it started burning through cash, did he pull the plug? Nope. He doubled down. And then he tripled down. It was all driven by this mix of hope and pride, this inability to admit he was wrong. And he just kept feeding it money until it had devoured not just his fortune, but his wife's fortune too. Everything. So we've seen genius fail. We've seen passion lead to ruin. This third story is a little different. It's about what happens when you are an undisputed master of your craft, but you get tempted to play in someone else's sandbox. It's all about the danger of drifting outside your circle of competence. And the guy we're talking about here is Michael Steinhardt. This man was an absolute legend, a titan, one of the original hedge fund guys. And his thing, his area of expertise, was U.S. stocks. That was his lane. He didn't just understand them, it felt like he had an innate sense for them. He lived and breathed the U.S. stock market. And his track record? I mean, just look at these numbers. It's insane. He averaged a 24.5% return every single year for almost 30 years. Let me put it this way. If you'd given him $1 back in 1967, it would have turned into $481. That same dollar in the S&P 500, it would have turned into $19. So yeah, he wasn't just good in his lane, he owned his lane. But here's the thing. He got so successful, his fund became so massive that it got harder and harder to find those great opportunities in his usual hunting ground. So, feeling the pressure, he started to drift. He started making these huge bets on things he didn't really understand. Foreign bonds, complicated currency trades. He stepped way outside his circle of competence. And the result was just devastating. In 1994, the Federal Reserve made a surprise move on interest rates, and his new, unfamiliar bets on foreign bonds just completely imploded. He lost $800 million in 4 days. And it wasn't just the money. The psychological scar of losing that much, that fast, playing a game he didn't truly understand, it was so bad that it eventually led him to retire. Okay, so we've seen the big traps, right? The trap of genius, the peril of passion, the danger of drift. But here's where we pivot. What if the biggest mistakes aren't just warnings? What if, sometimes, they can be the very foundation for something revolutionary? This is where we get to the real wisdom in failure. And honestly, there is no better example of this idea than the story of Jack Bogle. I mean, today we think of him as a saint of investing, the guy who made it possible for millions of regular people to build wealth. But what most people don't know is that his greatest creation was born directly from the ashes of his most humiliating professional failure. Just look at the story here. Back in the 60s, the go-go years, Bogle tried to keep up. He pushed for a big merger that turned into an absolute disaster. It wrecked his firm's performance, shattered its conservative reputation, and in 1974, he got fired from the company he was supposed to lead. I mean, totally humiliated. But it was right there, in that moment of failure, that he found his true calling. He realized that this whole game of trying to outsmart the market was a loser's game for almost everybody. So what did he do? 2 years later, he came back and launched the world's first ever index fund. All of Wall Street laughed at him. They literally called it Bogle's Folly. Well, guess what? Today, Bogle's Folly, the firm he founded, Vanguard, manages trillions of dollars for millions of people. And Bogle himself said it best. Sometimes in life, we make the greatest forward progress by going backward. That firing, that public humiliation, that was the giant step backward that made possible maybe the single greatest leap forward in the history of personal finance. He didn't just get over his mistake, he transformed it into a revolution, into his legacy. So, after all these stories, what's the big takeaway? I think it's this. Mistakes are going to happen. It's inevitable. We just saw Nobel Prize winners, literary giants, hedge fund legends. Nobody is immune. So the real test, for them and for you and me, isn't if we're going to make mistakes, it's what we do after. How we respond. So let me leave you with this question. When you make your mistakes, and you will, are you going to let them define you, or are you going to let them refine you? That's what really matters.
All right, let's get right into it. When you talk about the greats of investing, there's one name that's basically the bedrock for all of them, Benjamin Graham. This is the man who literally wrote the book on how to invest. But his story, it isn't just about timeless wisdom. It's about a crushing, catastrophic failure that gave birth to all that wisdom. And hey, don't just take my word for it. His most famous student, some guy you might have heard of named Warren Buffett, called Graham's book for the everyday person, The Intelligent Investor, the best book on the subject ever written. Period. I mean, that's the kind of legacy we're talking about here. A true giant. And yet, this same genius, the father of modern financial analysis, was once completely, utterly wiped out. So how in the world does the master of risk management lose it all? Well, that's the story we're going to unpack today. To really get why his failure was so shocking, you first have to understand just how brilliant this guy was. See, Ben Graham wasn't just another investor. He was an inventor. He walked into a world of backroom deals and pure guesswork and turned it into a real discipline. It's no wonder they called him the Dean of Wall Street.
I mean, just look at the world he transformed. Before Graham, Wall Street was kind of like a medieval guild, running on superstition and gut feelings. Graham came in and introduced rigorous, fact-based analysis. And he blazed that trail with one simple but totally revolutionary idea. The price of a stock and the value of the actual business behind it are two completely different things.
And he laid it all out in two foundational books. Security Analysis became the Bible for the pros on Wall Street. But it was The Intelligent Investor, written for regular folks, that really cemented his legacy. He just had this incredible gift for taking the confusing language of finance and boiling it down into simple, powerful concepts anybody could understand. And listen, he didn't just teach this stuff. He lived it, and for a while with just breathtaking success. In the roaring 20s, Graham wasn't just smart. He was a phenomenon, a true Wall Street rock star. Just check out this climb. He starts at the bottom in 1914, and by 1929, he's running his own show and posts a staggering 60% gain in a single year. He was absolutely crushing a market that was already booming. The man was on fire. And this number, this really tells the story. His fund started with about $450,000, and in just 3 short years, it ballooned to $2.5 million. You have to remember, in the 1920s, that was an absolute fortune. He was so confident, so on top of the world, that when the legendary Bernard Baruch, one of the most powerful men in finance at the time, asked Graham to be his partner, Graham said no. He was making so much money on his own, he figured he didn't need him. He felt invincible. And that, right there, set the stage for one heck of a fall. Then came the great crash of 1929. The very same market that had made Graham a star turned on him with a vengeance. And the man who preached caution was about to make the single biggest mistake of his life.
So here's the crucial point. After that first big crash in '29, Graham thought the worst was over. He looked around and saw bargains everywhere. And instead of just buying them, he borrowed heavily, used margin to buy even more. He was doubling down right when the floor was about to completely give out.
The result? It was catastrophic. Between the peak in 1929 and the absolute bottom in 1932, his fund lost 70% of its value. He wasn't just down, he was personally ruined, wiped out. The father of value investing had been financially destroyed. But this is where the story gets really good. Because Graham didn't let this failure break him. Instead, he forged it into a philosophy. The hard-won, painful lessons from his own ruin became the bedrock of modern investing for generations. And the biggest idea, his signature concept, was the margin of safety. It's a simple idea born from immense pain. You only buy something when it's selling for way less than you calculate it's actually worth. That discount, that buffer, that's your protection against bad luck, bad timing, and your own stupid mistakes. And he had this perfect analogy to explain it. You don't need to know a guy's exact weight to see that he's overweight. In the same way, you don't need to know if a business is worth exactly $80 a share or $100 to recognize that at $40, it's a fantastic bargain. The whole point is to be roughly right instead of precisely wrong. He also came up with this brilliant mental model to handle the market's wild emotional mood swings. He called it Mr. Market. Just imagine you have a business partner who is, well, he's manic depressive. Every single day, he shows up at your office either hysterically happy or suicidally depressed, offering to buy your shares or sell you his. Sounds like a terrible partner to have, right? But here's the genius of it. Graham realized that this emotional, irrational partner was actually your greatest advantage. So the question is, how do you win this game? Okay, so how do you beat him? Well, first, and this is key, you realize you're in charge. You don't have to accept his silly offers. Second, you treat his despair as your opportunity. When he's panicking and offering you shares for pennies on the dollar, you buy everything you can. And third, you just ignore his giddy optimism. When he's greedy and euphoric, you simply walk away.
So armed with these hard-won principles, Graham rebuilt his entire career and went on to beat the market for decades. But here's the thing. The world has changed a lot since his time, and his ultimate legacy is a little more complex than just buy cheap stocks.
Just take a look at this modern-day example. On one hand, you have Walmart. Over 5 years, they raked in $75 billion in profit, but their market value actually went down a bit. Then you have Amazon. They earned a tiny fraction of that, yet their market value skyrocketed by $350 billion. A classic by-the-book Graham analysis from the 1930s would have a really hard time explaining that.
And here's the absolute kicker. Graham himself knew this. Late in his life, he basically admitted that the game had changed. With so many smart people looking for bargains, he said, the old ways weren't as effective anymore. This intellectual honesty. Wow. That's maybe his greatest lesson. He never, ever stopped learning.
And that leads us to his ultimate lesson. It's not just about finding cheap stocks. It's about understanding that value is your anchor, but you cannot be a slave to a single, rigid definition of it. The world evolves, and your methods have to evolve with it.
In the end, the man who created the rules of investing taught us the most important rule of all. There are no ironclad laws. The market's going to do what the market's going to do. Cheap can always get cheaper, and your only true defense is a flexible mind and a profound sense of humility. Which leaves us with one final thought to chew on. If Benjamin Graham, the master himself, the guy who started it all, learned the hard way that his own rules weren't absolute, what rigid rules or beliefs in your own life might be worth re-examining? All right, let's talk about a story that every investor needs to hear. It's about a true market legend. I mean, a guy who lived and breathed every single trading maxim you've ever heard. But this isn't just some story about success. No, this is really a cautionary tale about how the most famous pieces of advice can actually be the most dangerous traps.
I mean, we've all heard this one, right? It's the absolute cornerstone of investing wisdom, boiled down to just 4 simple words. It feels so intuitive, so obvious. It's like the first rule of the game.
And then there's this one, a little more dramatic for sure, but it's the same core idea: be greedy when everyone else is scared. These sayings, they feel like timeless truths, you know, like little shortcuts to making smart decisions when things get messy.
But, and this is the really crucial question we're going to dig into, what if relying on these simple rules is actually the most dangerous thing an investor can do? What if they're not guardrails helping you stay on the road, but blindfolds? See, the real problem is that these rules of thumb, what psychologists call heuristics, are massive oversimplifications of a world that is anything but simple. They completely mask the true messy complexity of financial markets, and that creates these huge blind spots that lead us into making the same bad decisions over and over and over again. So yeah, a heuristic is just that. It's a mental shortcut. Our brains use them constantly to make quick judgments without having to do a whole deep, complex analysis. And most of the time, they're pretty helpful. But when the stakes are high, like with your money, they can lead us disastrously astray.
This slide right here illustrates the problem so perfectly. It's a classic puzzle from the psychologist Daniel Kahneman. So you're given a description of a guy named Steve. He's shy, he's tidy, loves detail. Then you're asked, is he more likely to be a librarian or a farmer? Now, almost everyone immediately says librarian, right? Because he fits the stereotype perfectly. But in doing that, we ignore a critical statistical fact. There are so many more farmers in the world than librarians. Statistically, it's way more likely that Steve is a farmer. We let a compelling story, a heuristic, completely override the cold, hard data. And that is exactly the trap investors fall into all the time.
And you know, no one embodies this paradox more than Jesse Livermore. This guy was the original market speculator, the man whose wisdom is still quoted constantly today. But he was also a man who made and lost several massive fortunes and ultimately died completely broke. His life is the ultimate case study in the danger of knowing all the rules but being psychologically incapable of actually following them.
Livermore's story, it starts out like a classic American dream. He was born on a farm in 1877, and he decided pretty quickly that that life was not for him. So he ran away from home, searching for something much bigger.
I mean, just look at this timeline. It really captures his insane rise. At 14, he runs away to Boston. By 15, after working as a kid who writes stock prices on a board and secretly journaling market patterns, he makes his first real score. By the time he's 20, he's so good at beating these places called bucket shops, which were basically gambling parlors that took bets on stock prices, that he gets banned from every single one in Boston. They nicknamed him the Boy Plunger for his aggressive all-or-nothing style. He was a pure, raw talent.
But his career was never a straight line up, not even close. It was this violent, repeating cycle of spectacular wins followed by catastrophic, soul-crushing losses. And this pattern, it would come to define his entire life, both in the market and outside of it. His first huge score came in 1906. He had a hunch, and he decided to short the railroad company Union Pacific, which just means he placed a bet that its stock would go down. And then a massive earthquake hit San Francisco. While the market kind of shrugged it off at first, Livermore was convinced it was going to cause a crash. He held his position, even doubled down. He called this sitting, just having the patience to see a trade through. And boy, did it pay off. He made $250,000, which today would be worth over $6 million. But here's that pattern again. Almost immediately after this massive win, he jumps right back in, shorting the market again. But he was too early, and in a flash, he lost 90% of his winnings. And what's so fascinating is how clear he was about it later. He knew exactly what he did wrong. His idea was right, but his timing, his play, was completely off. And yet, he rebounds spectacularly. During the huge panic of 1907, as banks were failing left and right, Livermore was shorting the market. When the legend J.P. Morgan himself stepped in to save the day, Livermore cashed out. By the end of the year, before he was even 30 years old, he was worth $3 million, a staggering fortune at the time.
But then came the bust. He got into trading cotton and became friends with this world-renowned cotton expert named Teddy Price. Livermore was bearish on cotton. He thought it was going down, but Price, with all his seductive knowledge and data, convinced him he was wrong. So Livermore abandoned his own analysis, he followed Price's advice, and he got absolutely crushed, lost a fortune. And the kicker? Price, it turns out, was secretly shorting cotton the whole time.
This loss just devastated him, because he knew better. He completely violated one of his own cardinal rules. See, he had a profitable wheat trade going at the same time, but he sold that winner to pour more money into his losing cotton position, the exact opposite of what a disciplined trader is supposed to do. His personal rule, his heuristic, was cut your losses and let your winners run. But under pressure, he did the opposite. So after a string of other bad trades and getting taken advantage of by a brokerage firm, the cycle finally hit rock bottom. He was completely wiped out. In 1915, the boy plunger, the cotton king, was forced to declare bankruptcy. But Livermore's story was far from over. He staged another comeback, rebuilding his fortune during the World War I bull market. And that set the stage for the single greatest trade of his entire life, and, tragically, the moment that would seal his fate. Throughout the Roaring '20s, Livermore stayed a cautious bear. He just believed the market was totally unsustainable. So by the fall of 1929, he had built up this massive short position across 100 different stocks. And when the market crashed, he made $100 million. In today's money, that is over $1.4 billion. He was, for that moment, one of the wealthiest men on the entire planet. This should have been his crowning achievement, his ultimate victory lap. Instead, it was the beginning of his final tragic downfall. He made a series of absolutely catastrophic psychological errors. First, as you can see here, he stayed bearish. He kept fighting the market as it finally hit its historic bottom in 1932. Then, after getting totally crushed, he made his second mistake. He flipped his whole position and went all in on the market going up, right at the peak of a temporary rally, what traders call a dead cat bounce. And his third and final error was just holding that position as the market rolled over again and completely wiped out his entire fortune. And the final result was just absolute ruin. The man who was worth over $1 billion just a few years earlier was now broke again, and this time it was for good. By 1934, he was $5 million in debt and declared bankruptcy for the second and final time. He would never, ever recover.
So what are we supposed to make of all this? It's just so ironic that the most quoted trader of all time showed such unbelievably poor risk management. The real lesson from Jesse Livermore's life, it isn't found in his famous, catchy market phrases.
Now, the real lesson is in this much more profound and, honestly, much more tragic quote from Livermore himself. He understood that you might learn not to make the exact same mistake again, but the family of mistakes, it's vast. Human psychology always finds new and creative ways to fail, especially when we're under pressure.
So, if we look past all the famous quotes, these are the real rules that Livermore's life teaches us. The lesson isn't about timing the market. It's about discipline. It's about understanding that risk management is literally everything. It's accepting that losing money is inevitable and that repeating your mistakes is just part of the human condition. The real goal isn't perfection. It's to build a process that helps you avoid those simple, unforced errors that our own psychology, our reliance on those simple rules, sets us up for.
And that really leaves us with a final question to think about. We all have our own mental shortcuts, right? Our own rules of thumb, not just in investing, but in life. And it's worth asking yourself, which one of those simple, trusted rules might actually be your biggest, most hidden risk? Thanks for tuning in.
You know, we all know Mark Twain, the literary genius, right? The guy who gave us Huckleberry Finn and Tom Sawyer. But what most of us don't know is that the man behind the pen name, Samuel Clemens, he was a truly catastrophic investor. He made one of the single biggest financial blunders of his era, and that is the story we're going to get into today.
It all boils down to this one simple thought. A thought that, let's be honest, anyone who's ever invested in anything, a stock, a project, whatever, has probably had at some point. I'll just get out when I'm even. It sounds so responsible, doesn't it? So reasonable. But I'm telling you, that phrase right there is one of the most poisonous thoughts an investor can ever have.
So why is it so incredibly dangerous? Because it has nothing to do with a financial strategy. It's a strategy for your ego. It's a trap. See, by holding on to a loser, you get to put off admitting that you were wrong. You get to defer that feeling of defeat. But here's the problem. As those small losses start to snowball into really big ones, the little bit of hope you had, it curdles into fear. And that's the moment all rational thinking just flies right out the window.
And this is the point where our emotions, our ego, our hopes, they all collide with a cold, hard, unforgiving reality. Because getting back to even, it's not a one-for-one journey. The numbers are totally stacked against you, and they get so much worse the deeper the hole you've dug for yourself.
Just look at this. Look at how brutal the math gets, and how quickly. If your investment drops 20%, okay, you need a 25% gain to break even. That's doable. But what if you lose half your money? A 50% drop? Well, now you need to double what you have left, a 100% gain, just to get back to where you started. And if you're down 80%, forget about it. You need a mind-boggling 400% return. The hole doesn't just get deeper, the climb out becomes almost impossible.
And that leads to the next part of this psychological trap. We tell ourselves, okay, this is it. It can't possibly go any lower. But it absolutely can. As the hedge fund manager David Einhorn famously said, there is no magical floor. A bad investment can always get worse. Just because something's fallen from $100 to 20 doesn't mean it can't fall to 10 or to 0.
In fact, the data here it's pretty grim. A study from JP Morgan found that since 1980, a full 40% of all stocks that have a catastrophic 70% decline never recover. Ever. They just keep on digging. And you know what? Nobody in history dug a deeper hole for himself than the great Mark Twain.
So, let's get into the man himself. We admire Mark Twain, the author. But it was Samuel Clemens, the man, who was single-handedly responsible for torpedoing Mark Twain's fortune. By pretty much all accounts, he was an absolute magnet for terrible ideas.
I mean, his biographer, Richard Zacks, really doesn't pull any punches here. Twain wasn't just unlucky. He was uniquely, almost impressively bad at this. He managed to lose not only his entire fortune, but also the fortune of his wife, who was a wealthy coal heiress, all through this string of just truly appalling investment decisions.
The lesson he never seemed to learn is maybe one of the simplest pieces of wisdom out there. It's often called the first law of holes. When you find yourself in a hole, the very first thing you do is you stop digging. But Twain, he just kept shoveling, man. He just kept digging, always convinced that treasure was just one more shovelful away.
And believe me, it wasn't just one bad investment. Oh no. Before the one truly catastrophic bet that brought the whole house down, there was a whole parade of them. It was a long, consistent, almost dedicated history of making terrible financial choices.
I mean, the list is almost comical when you look at it. Gold mining, of course, something called the New York Vaporizing Company,
milk powder, a new kind of steam pulley, a startup insurance company. He was especially a sucker for inventors. He once funded a guy who was supposedly improving steam engines, giving him $35 a week. Twain later said, "I early noticed by his breath and gait that he was spending $36 a week on whiskey, and I could never figure out where he got the other dollar."
The funny thing is, despite all the failures, at least he gave us some of his classic wit. After his disastrous mining investments, he came up with this gem. So he was self-aware enough to see the folly in it all, but that awareness just never seemed to translate into making better decisions. It's wild.
And his terrible judgment, it cut both ways. He made what we call errors of commission. That means actively investing in bad ideas, like sinking a ton of money into a new engraving process that went absolutely nowhere. But he also made these devastating errors of omission. He was personally invited by Alexander Graham Bell to invest in his newfangled invention, the telephone. Twain passed on it. He called it wildcat speculation, and in doing so missed out on one of the greatest fortunes of the century.
But all of those were just the warm-up act. Now we're going to slow down and focus on the main event, the one investment that made all the others look like pocket change. This is the story of the machine that ate Mark Twain's entire fortune, the Page typesetter.
Now, this wasn't some quick flash-in-the-pan loss. No, this was a slow-motion train wreck that unfolded over 14 years. It starts in 1880. He meets the inventor, James Page, and he is immediately captivated. He starts pouring money into it, even using the profits from his wildly successful publishing house to just keep feeding this machine. For over a decade, he just kept digging, always convinced that he was just on the verge of a world-changing breakthrough.
So, what was the final bill? The total loss from this one machine, the Page typesetter, is estimated to be somewhere close to $5 million in today's money. Just let that sink in for a second. An absolutely staggering amount. This single machine, this one refusal to just stop digging and admit he was wrong, bled him completely dry.
But you know what's so fascinating about all this? Twain knew he was being conned. On some level, he absolutely saw the inventor, James Page, for the charismatic charlatan that he was. He actually wrote this about him, calling him a majestic liar. But when Page was in the room spinning his tales, Twain couldn't help himself. He believed the story, and he kept writing the checks.
Well, eventually, the machine broke down for the last time. The money was gone. And this led to total public humiliation, to bankruptcy. It was the absolute lowest point in Mark Twain's life. But what he did next, well, that tells us everything we need to know about his character.
This was the day it all came crashing down. His publishing company, the very engine that had been funding all his speculation, officially went bankrupt. He was completely out of options. He was completely out of money.
Now, legally, under the bankruptcy laws of the time, he was free. His debts were cleared, he could have just walked away and started over, a free man. But he refused. He made this incredible public statement declaring that he would repay every single one of his creditors in full. For him, this wasn't about the law, this was about honor.
So at 59 years old, an age when most people are thinking about slowing down, Mark Twain set off on this grueling, year-long around-the-world lecture tour. He went all across America, to Australia, to India, to South Africa, performing night after night to pay back every last dime. It took him 4 years, but he did it. He paid back every single one of his 101 creditors.
And this is the proof that the whole painful experience finally taught him the lesson. A few years after he got out of debt, he invested in another new speculative machine. But this time was different. After just 8 months of empty promises and no results, he recognized the pattern. He said it felt like déjà vu, and he walked away. He cut his losses. He had finally learned how to stop digging.
So what's the big takeaway for us from Twain's incredibly expensive mistake? It really boils down to a simple 2-step strategy to protect yourself. Step 1. Before you put a single dollar into anything, you decide your exit point. What is the absolute maximum loss you are willing to accept? Step 2. And this is the important part. You let that preset rule make the decision for you. Not your ego, not your hope, not your fear when things start going south.
You know, in the end, Mark Twain's story is really a cautionary tale for all of us. Maybe it's not a $5 million typesetting machine, but we all have that project, that stock, that thing we just keep pouring time and money and energy into, always hoping it's just about to turn around. So it kind of leaves us with a question we should probably ask ourselves. We all have a money pit somewhere in our lives. What's yours?
Today we're going to talk about a hedge fund that, I kid you not, probably had more IQ points per square foot than any other place on the planet. We're talking about a team so brilliant they thought they had cracked the code, that they had turned risk itself into a pure science. But what happens when the smartest people in the room start believing their own hype? Well, this is the story of John Meriwether and the very dangerous limits of genius.
I can calculate the motions of the heavenly bodies, but not the madness of the people. Just let that one sink in for a second. That's from Sir Isaac Newton, and it really gets to the heart of what we're talking about today. It's this epic battle between pure, cold, mathematical logic and the wild, unpredictable, and let's face it, often totally irrational behavior of human beings.
It's a great question, isn't it? Because as it turns out, the very same human instincts that cost one of the smartest men in all of history of fortune are the exact same ones that brought a modern financial empire, an empire built by Nobel Prize winners armed with supercomputers, crashing to its knees.
So, to really understand how a 20th century financial giant just imploded, we actually have to go way back. We're talking 1720. We have to look at a huge mistake made by the ultimate symbol of genius himself.
You know, it's almost impossible to overstate how smart Newton was. We are talking about a mind that just operated on a completely different level than pretty much anyone else. He basically invented modern physics. You would think a brain that could map out the entire cosmos would be, immune to simple financial blunders. Well, you'd be wrong.
So, back in 1720, London was gripped by this absolute frenzy over something called the South Sea Company. Newton, being a pretty rational guy, he got in early, he made a fantastic trade, and walked away doubling his money. A huge profit. A perfect, logical, smart move. Case closed, right?
And this is where the human part kicks in and just ruins everything. He cashed out, but the stock kept going up and up. He had to sit there and watch his friends, his neighbors, people he knew were nowhere near as smart as him, get fabulously wealthy. And that feeling, that regret, that envy, that FOMO, it was just too much. He couldn't stand it. So he threw his rational brain right out the window and plunged back into the market with a huge chunk of his fortune, right near the absolute top.
The result? Utterly catastrophic. When that bubble burst, it took just a few weeks for the price to just plummet. Newton lost nearly everything, a fortune that today would be worth millions and millions of dollars. They say he couldn't even bear to hear the word South Sea spoken for the rest of his life. So here's the key. Even the most powerful intellect on Earth is no match for our most basic gut-level instincts. Now, Newton's story isn't just some dusty old anecdote. It actually reveals a fundamental flaw that affects really smart people in high-stakes games. Let's call it the genius trap. And it has two key ingredients.
The first ingredient is just good old-fashioned overconfidence. This number here comes from a classic study where college professors, some of the most educated people around, were asked to rate themselves. And get this, 94% of them rated themselves as above average compared to their peers. 94%. We all have a little bit of that Isaac Newton in us. We all think we're just a little bit smarter than the next person.
And as the legendary investor Charlie Munger so bluntly points out, the math on that just doesn't work. By definition, everybody can't be above average. This widespread overconfidence, it's the psychological fuel for our little recipe for disaster. But it's not the only ingredient. The second ingredient is this fascinating idea, the paradox of skill. Think about it like this. Back in the 1950s, a single smart person could probably find a real edge in the stock market. But today, something like 90% of all trading is done by massive institutions with armies of PhDs and supercomputers. The baseline level of skill is just incredibly high now. So when everyone is a genius, being a genius is no longer a special advantage. Success becomes less about who's the smartest and a whole lot more about who gets lucky. And that was the world long-term capital management was born into.
Okay, so let's jump to our modern-day case study and see how this all comes together. We're going to look at a firm that perfectly embodied both of these things, overconfidence and the paradox of skill. I'm talking about John Meriwether's Long-Term Capital Management, or LTCM for short.
I mean, just look at this lineup. It is absolutely staggering. You've got John Meriwether, a total legend in bond trading. He assembles a team that's less of a hedge fund and more of a financial Manhattan Project. You have not one, but two guys who would go on to win the Nobel Prize. You have the man who co-invented the Black-Scholes formula. That's the equation used to price pretty much every financial option in the world. And for good measure, throw in a former vice chair of the Fed. It was just an unprecedented amount of brainpower in one room.
This quote from Fortune magazine at the time really sums it all up. The feeling wasn't just that these guys were smart, it was that they were the smartest people to ever play this game. They didn't even see themselves as traders making bets. As one of the partners, Myron Scholes, put it, they saw themselves as a financial technology company, just vacuuming up nickels and dimes that were too small and too complicated for anyone else to even see. And for a while, their models were perfect. The results were just incredible. Look at these returns. 43% after fees in 95, 41% in 96. Now, to put that into perspective, in 1996, this small group of academics and traders made over $2.1 billion in profit. That was more money than global giants like McDonald's or Disney or American Express made that year. They were on top of the world.
But as we learned from our friend Isaac Newton, the higher you fly, the harder you can fall. And the very thing that made them so successful, this unwavering, absolute belief in the scientific certainty of their own models, was about to become their undoing.
So, how did they set their own trap? Well, it all started with a decision that, on the surface, seemed pretty smart. In late 1997, they returned about $2.7 billion to their investors. But, and this right here was the fatal mistake, they didn't shrink the size of their bets. So imagine, you've got $100 of your own money, and you've borrowed $1,800 to make a massive bet. Now imagine you give away $50 of your own dollars, but you keep the full $1,800 bet on the table. All of a sudden, you are way more exposed. That's exactly what they did. Their capital base got smaller, but their position stayed just as huge. Instantly, their leverage shot up from an already high 18-to-1 to a frankly insane 28-to-1, and it would eventually climb to over 100-to-1. They were sitting on a financial time bomb.
And in 1998, that bomb went off. It started with some losses in May and June. Then, in August, Russia defaulted on its debt. It was the ultimate black swan event, one of those vanishingly rare, unpredictable disasters that their models basically said was impossible. The entire financial world panicked, and LTCM's hugely leveraged positions just started to bleed uncontrollably. The timeline of this collapse is just terrifyingly fast. Now, their computer models, the source of all their confidence, had calculated that on their absolute worst day, the most they could possibly lose was maybe $35 million. Well, on August 21st, 1998, they lost $550 million in a single day. This was the moment their faith in quantifiable science completely shattered against the rocks of reality. But the bleeding didn't stop. It was relentless. One of the sources for this story described it as a biblical plague of losses. On Monday, September 21st, they lost another $553 million. In just 5 weeks, the partners' entire personal investment in the fund and billions of dollars of investor money was gone, just wiped out.
The fallout was so immense that the Federal Reserve itself had to step in and orchestrate a massive bailout because they were afraid that LTCM's failure could actually take down the entire global financial system, which, of course, leads us to the central question of this whole insane story.
I mean, really, how? How could a room full of Nobel laureates and PhDs with resumes that were just flawless, how could they make such a colossal, fundamental error? It wasn't just about simple overconfidence.
The answer is right here. It's in the massive gap between their world and the real world. Their models were beautiful, they were elegant, they were scientific, and they created this powerful illusion of control. They could calculate risk based on historical volatility down to the 100th decimal point. But you know what their models had no variable for? Pure, unadulterated human panic. They calculated the odds of everything, but they were totally blind to the possibility of the impossible. In the end, they could calculate the motions of the markets, but just like Newton, they could not calculate the madness of the people.
And that really is the takeaway for all of us. The story of LTCM isn't just a history lesson about finance. It is a timeless warning. It forces us to ask ourselves, where in our own lives, in our own careers, or in our own investments, are we confusing our elegant models with messy reality? What are we so certain about today that we might look back on tomorrow as our very own genius trap?
All right, today we're going to talk about one of the greatest comeback stories in financial history. Seriously, it's a story about a massive, career-ending failure, and how that exact failure gave birth to an idea that would completely change how millions of us invest our money forever. Just look at this number for a second. $4 trillion. That's how much Vanguard manages today. I mean, it's a number that's almost impossible to even wrap your head around. It is an absolute behemoth in the industry. So you have to ask, how did it get so huge? You'd think there was some secret sauce, right? Some complex trading algorithm nobody else had. But nope. That entire $4 trillion empire was built on a single, kind of strange, and, at the time, really unpopular idea. That's it. That was the big idea. Just stop trying to be a hero, stop trying to find the needle in the haystack and beat the market. Instead, just accept the market's average return. And this wasn't some new flash of genius. It was the core idea Jack Bogle wrote about way, way back in his Princeton thesis in 1951. And that, right there, is the big question we're digging into. If this idea was so simple and powerful, why on earth did Wall Street laugh at it? Why did they call it Bogle's folly? Why did nobody want anything to do with it? Well, to get that, you have to understand the man, his spectacular failure, and his ultimate redemption. So here's the game plan. We're going to walk through his incredible story in 6 parts. We'll start with his early days and this legend of average, then get into the seductive siren song of go-go investing, see his career literally go up in flames, watch how an idea was born from that failure, see Bogle's folly finally triumph, and then, at the end, talk about what it all means for you. Okay, so let's start at the beginning, because this story doesn't begin with failure. It actually starts with unbelievable success. Bogle was a whiz kid, a real rising star, and he'd had his big idea from day one. You know, what's so wild about this timeline is just how fast it all happened. 1951, he writes this paper saying, hey, most people can't beat the market average. That same year, he gets hired by Walter Morgan, the founder of the Wellington Fund, this super conservative, old-school firm that was famous for being careful. Bogle just shoots up the ranks, and by the time he's 36, the founder himself handpicks him to take over. By 1970, he's the CEO. I mean, the guy is on top of the world. But here's the thing. The world around him was changing. That steady, conservative style that built Wellington, suddenly it started to look boring. It looked slow. There was this new, exciting, almost intoxicating philosophy taking over Wall Street. Yeah, in the mid-60s, Wellington's numbers started to, well, sputter. While they were playing it safe, these new go-go funds were all over the news, making flashy trades and posting huge returns. The pressure to keep up was just immense. As Bogle himself said later, he got lured by the siren song of the go-go years and just mindlessly jumped on the bandwagon. So to try and catch up, Bogle makes this fateful decision. He merges Wellington with this young, super aggressive Boston firm that ran something called the iVest Fund. And this right here just shows you the insane culture clash. Wellington was all about stability, playing defense. iVest was the exact opposite. Speculative, rapid-fire trading. They wanted fluctuations. It'd be like Vanguard merging with a high-flying crypto trading firm today. It just made no sense. And here it is, straight from the man himself. He lays out the whole tragedy in one sentence. For a little while, it looked like a brilliant move, but that culture clash was a ticking time bomb. Bogle even admitted their management skills were basically zero. And they weren't just about to blow up their own funds. They were going to take the entire Wellington empire down with them. And that one decision, well, it snowballed into an absolute total disaster. The new era hotshots Bogle brought in were now running the show, and they were about to steer the ship right into an iceberg. This line from their own 1967 annual report, it just says everything. That careful, defensive strategy that Wellington was built on, gone, replaced with this aggressive new mantra. They loaded up on stocks and started trading like crazy right as the market was hitting a speculative peak not seen since 1929. The timing was, well, it was just catastrophic. So when that bubble finally burst between 73 and 74, the carnage was just unbelievable. The S&P 500 fell 31%, which is bad enough, but these new speculative funds they'd embraced, they were completely obliterated. iVest lost 55% of its value. Explorer down 52%. Morgan Growth down 47%. So much for a strong offense. But the real gut punch, the deepest cut of all, was to the crown jewel itself, the Wellington Fund. The once mighty fund peaked at $2 billion in assets. After the crash, its assets had collapsed by 75%, cratering to just $470 million. Its reputation, built over decades of careful work, was in tatters. And in the end, someone had to take the fall. The board laid the blame for the whole disastrous merger right at the feet of the man who put it all together. The one-time whiz kid, Jack Bogle, was fired from the company he was supposed to lead into the future. It was rock bottom. But, sometimes hitting rock bottom is exactly what you need. As Bogle himself said, we make the greatest forward progress by going backward. Being fired, being humiliated, that was the catalyst. It forced him to rethink absolutely everything. So, angry at himself for chasing those go-go managers, he went back, all the way back, 25 years back, to that simple idea from his college paper. And he thought, what if the goal isn't to be smarter than everybody else? What if the goal is just to capture the market's return as cheaply and efficiently as possible? He somehow convinced the funds board to let him create a new, separate company just to handle the boring administrative stuff. He called it Vanguard. And the way he set it up was a direct shot at the greed he'd just seen destroy his career. It was revolutionary. The mutual funds themselves would own the company. No outside shareholders demanding profits. This meant Vanguard could operate at cost, putting the investors, not the managers, first. So with this new company in place, Bogle finally had the chance to launch his big idea, the world's very first index fund. But Wall Street, they were not impressed. In fact, they openly laughed at the idea. Just look at these numbers. The launch of the first index investment trust was a complete and utter failure. They were hoping to raise $150 million. They brought in just over $11 million. That's a 93% shortfall. It was a disaster. And this is why they called it Bogle's Folly. It just looked like another terrible idea from a washed-up executive. But Bogle, he pushed on. He just knew he was onto something. And this chart right here, this is the ultimate I told you so. Over the next few decades, the data proved him right in a huge way. The Vanguard 500 Index Fund returned 10.4% a year, while the average active fund manager returned just 9.2%. Now that 1.2% difference might not sound like much, but compounded over an investing lifetime, it is absolutely everything. It was basically the exact gap he'd predicted in his college paper almost 40 years earlier. And the idea that started as a joke, a folly, eventually became recognized for what it was, a full-blown financial revolution. I mean, listen to this from Nobel Prize winner Paul Samuelson. He wasn't kidding around. The index fund, for the first time in history, gave the average person a fair shake. So, what do we take away from all this? From this incredible story of failure and redemption? Well, I think the lesson isn't just about index funds. It's something a lot more personal than that. Jack Bogle was 47 years old when he created the index fund. 47. He'd already had a full career, right? A crazy rise to the top and then a humiliating fall. And his greatest contribution, the thing we'll always remember him for, it came after all of that. Speaking as a guy who's 45 myself, this part of the story really hits home. His journey shows us that investing isn't about one brilliant move. It's this long, winding path of figuring yourself out. You're going to try things that don't work. I know I did. I wasted years thinking I could be some superstar trader before I finally realized that just wasn't me. Failure is just part of the process. The important thing is that it's never too late. The goal isn't to be a genius. The goal is to find a simple, repeatable process that you can actually stick with. One that works for you.
Think about it. Bogle's greatest failure came when he chased a style that wasn't his. And his greatest success? It came when he went back to an idea he'd believed in his whole life. He finally found what worked for him. So I guess the question I want to leave you with is, have you?
Today, we're going to talk about a cautionary tale from the absolute peak of Wall Street. It's a story about what happens when genius and ego collide, and it reveals what might be the single most important rule in all of investing. We're digging into the story of the legendary Michael Steinhardt and the one catastrophic mistake that proves even the titans can come crashing down to earth.
So let's just jump right in with the big question. How on earth does something like this happen? We're not talking about a rookie mistake here, or just a bit of bad luck. We are talking about one of the sharpest, most successful minds in the history of the business making a blunder of truly epic proportions. So, how does it happen? And maybe more importantly, what can the rest of us actually learn from it?
Before we get into the how, I just want you to look at this number. Let it sink in for a second. $800 million. Poof, gone. In 4 days. That's not a bad week at the office, my friends. That is a career-defining, soul-crushing kind of loss. And this number, it's the direct result of one single fatal decision: straying from what you know best.
Okay, so here's how we're going to break this down. First, we'll look at the downfall of our genius Michael Steinhardt. Then, we're going to contrast that with a powerful story from the Oracle of Omaha himself, Warren Buffett. From there, we'll nail down the core lesson here, something called the circle of competence. Then we'll explore the psychology of why we all tend to stray from it, and we'll wrap it all up with some real practical advice.
So, let's start with our main character. You have to understand, Michael Steinhardt wasn't just another guy in a suit. He was a pioneer, an absolute icon. We're talking about one of the founding fathers of the entire hedge fund industry, right alongside guys like George Soros. This was a man who was practically born to pick stocks.
I mean, look at this timeline. Steinhardt's entire life was built around the U.S. stock market. He starts investing with his bar mitzvah money when he's just 13 years old. By 1967, he's got his own firm. And when the bubble of the late 60s burst and wiped out a ton of his peers, Steinhardt's fund was the one left standing at the very top. For almost 30 years, the guy seemed completely unstoppable, until one day he wasn't.
And if you want to know just how good he was, this slide says it all. His average annual return was 24.5%. To put that in perspective, if you'd put 10 grand with him back in '67, by the time he retired, you would have had over $4.8 million. That same 10 grand in the S&P 500, 190,000. That is the definition of an investing genius.
But that genius came with this legendary intensity. Steinhardt was famously aggressive, he was emotional, and, by his own admission, a total tyrant. He told this story about a portfolio manager who messed up. That fiery, obsessive passion, that's what made him so successful. It's what drove him to analyze his portfolio 6 times a day. But that same fire, well, it would eventually lead to his burnout.
And this is where the story takes its critical turn. By the early 90s, Steinhardt is managing almost $5 billion. That's a staggering amount of money, and it created this really strange problem. See, his whole specialty, his bread and butter, was finding hidden gems in small and mid-sized U.S. companies. But now his fund was just too big. He couldn't put any real money into those smaller companies without completely blowing up their stock price. His own success had made his winning strategy useless. So what did he do? He went hunting elsewhere, way elsewhere. He pivoted from U.S. stocks, where he had decades of experience, deep relationships, a real edge, and he plunged into foreign bonds, global currencies, and complex derivatives in markets he barely understood. He basically started trying to play the global macro game like George Soros, but without Soros's unique feel for it. He was playing a totally different game, one where he had zero advantage. The immediate result, of course, was that $800 million loss. But the thing is, what's often more damaging than losing the money is the psychological scar that it leaves behind. After one strong comeback year, Steinhardt just called it quits. He retired for good in 1995 at only 54 years old. The game that he had owned for 3 decades had taken something from him he could never get back, all because he stepped outside his lane.
All right, now for part 2. For a perfect contrast to Steinhardt's story, we're going to turn to Warren Buffett. He faced a very similar temptation during the dot-com bubble of the late 90s, but he made the exact opposite choice.
You have to remember what the late 90s were like. The world was going absolutely bonkers for anything with a .com at the end of its name. And in the middle of all that, Warren Buffett started to look like this out-of-touch old man. He famously said, "Look, I don't understand semiconductors. I don't know how to value these internet companies," so he just stayed away. And for that, the media, a whole new generation of investors, they openly mocked him. They said his time was up.
And this chart just brilliantly shows the kind of pressure he was under. While his company, Berkshire Hathaway, was actually losing value, the tech-heavy NASDAQ was just screaming higher. You had individual stocks like Qualcomm up over 400% in a single year. Can you imagine the discipline it took to watch that happening and not jump in, to not start questioning everything you believed in as an investor?
This slide just captures the pure absurdity of that time so perfectly. On one hand, you have a company like eToys, which was losing tens of millions of dollars. On the other, you have Toys R Us, a profitable established giant with 150 times the revenue. And yet, the market valued the money-losing company at $2 billion more. This was the kind of insanity that Buffett was resisting. He couldn't make it make sense, so he just wouldn't buy it.
So how much did Buffett bend? How many of those hot tech stocks did he finally buy just to stop the bleeding and shut up the critics? 0. How many of his own Berkshire Hathaway shares did he sell in a panic as his personal net worth was plummeting by billions? 0. He stuck to his guns with absolute ironclad conviction. And well, we all know how that story ended for the dot-com investors, don't we?
Okay,
So the stories of Michael Steinhardt and Warren Buffett, they're really just two sides of the exact same coin, and they both powerfully illustrate one of the most fundamental concepts, not just in investing, but in life.
It's called the circle of competence, and the idea is actually really simple. Know the boundaries of your own knowledge, and then make a very conscious effort to stay inside them. The important thing isn't how big your circle is. What matters is being brutally honest with yourself about where that border lies. Steinhardt's downfall was a direct result of him completely ignoring his. Buffett's incredible long-term triumph was a direct result of him respecting his.
Buffett's longtime partner, the late, great Charlie Munger, he put it even more bluntly. I love this quote. It applies to everything, not just stocks. It's about knowing where you have an edge and where you don't. Steinhardt had a massive, undeniable edge in U.S. stocks. He had zero edge in European bonds. He was playing a game he was pretty much destined to lose from the start.
So if this rule is so simple and so powerful, why is it so incredibly hard to follow, right? Why do even the smartest people on the planet constantly feel that pull, that temptation to stray outside their circle? Well, the answer lies deep inside our own heads.
You see, there's this well-documented thing in finance called the behavior gap. And what it proves over and over again is that the single biggest threat to our investment returns, it isn't a bad market, it's our own behavior. It's that fear of missing out, that FOMO, that makes us pile into some hot new thing we don't really understand. And it's pure panic that makes us sell everything at the absolute bottom. More often than not, we are our own worst enemy.
And if you want proof, just look at this number. It's staggering. One study found that from 2009 to 2016, the average investor in the biggest S&P 500 ETF, a dead simple index fund, underperformed the fund itself by a grand total of 115%. How is that even possible? It's possible because they were trying to be clever. They were jumping in and out, trying to time the market, instead of just staying in their lane and holding on.
Which brings us to our final and maybe most important section. How do we actually apply these lessons? How do we stay disciplined while also, continuing to learn and grow as investors?
Look, the lesson here isn't to never leave your comfort zone. It's about how you do it. Venture out, but with extreme caution and a clear plan. So if you want to explore a new area, first, do the homework. Really, truly understand it. Second, start small. Don't go betting the farm on some new idea. Third, know your exit. Decide how much you're willing to lose before you ever invest a single dollar. And finally, just remember, the goal is to stay in the game. Survival is everything. So I'll leave you with this last question to think about. It's pretty easy to look at a portfolio statement and list off the names of what you own. It is much, much harder to draw an honest circle around the things you genuinely, deeply understand. And the story of Michael Steinhardt is just a powerful reminder that the difference between those two things, it can be worth millions or even billions of dollars. Thanks for tuning in. You've been there, right? You're on a hot streak, everything you touch turns to gold, and you start to think, wow, I've really figured this thing out. But what if that genius wasn't genius at all? What if it was just luck? Today, we're going to dive into the story of Jerry Tsai, a man who was once hailed as the greatest genius on Wall Street. His incredible rise and even more spectacular fall is maybe one of the most important cautionary tales in the history of finance. Let's get right into it.
This quote right here, this is everything. It's the whole story in a nutshell. It's so easy to believe our successes are a result of our own brilliance, especially when the entire market is screaming upwards. But Humphrey B. Neal gave us this critical warning. And it's a warning that Jerry Tsai, and pretty much everyone who threw their money at him, was about to learn in the most painful way possible.
And there's actually a psychological term for this. It's called attribution bias. It's pretty simple, really. When our investments go up, it's because we're smart, right? We did the research, we saw the trend, but when they go down, that's just bad luck. Or the Fed did something, or, it was just an unlucky break. This is the mental trap that makes a bull market so incredibly dangerous. It convinces us we can't lose, and it pushes us to take bigger and bigger risks.
So here's our roadmap for today. First, we're going to dig into the psychology that makes us all feel like investing gods during a bull run. Then, we'll set the stage on Wall Street, a place that was still haunted by the past, but was desperate for a new kind of star. We'll watch Jerry Tsai's meteoric rise, get swept up in the absolute mania of his Manhattan Fund, and then we'll see what happens when the music stops. It's a story for the ages, with a lesson that's as relevant today as it ever was.
All right, let's start with that core puzzle.
Why is it that a rising market has such a powerful and, let's be honest, often blinding effect on our judgment?
It's like playing a slot machine that's just rigged to win. Every time you pull the lever, every time you buy a stock, you get a little reward. Your brain gets a shot of dopamine. It feels good, it feels smart. So what do? You do it again, maybe with more money this time. But here's the trap. A rising tide lifts all the boats. In a roaring bull market, even the dumbest investment decisions can look like strokes of pure genius, at least for a little while.
Now, to really understand how one man became such a phenomenon, we need to travel back in time. We need to understand the world he was walking into. This wasn't just any old bull market. This was a Wall Street that had been hollowed out by the ghosts of its past, leaving a massive opening for someone new.
Think about this. The shadow of the 1929 crash was incredibly long. It took a full 25 years for the Dow just to get back to where it was. An entire generation of Americans was so scarred by the Great Depression and World War II that they wouldn't go near the stock market. This created a huge vacuum. The old guard, with all their cautious, grim memories, were on their way out, and the market was just waking up, ready for a new, younger generation that had never known a catastrophic crash.
8. Just 8 people. Let that sink in for a second. For over 2 decades, pretty much no new blood was coming into the New York Stock Exchange. A massive void had opened up. And what that meant was, for the first time ever, being young was a huge advantage. If you were ambitious, if you were fearless, and if you weren't terrified of the ghosts of 1929, Wall Street was wide open for the taking.
And into this world steps our guy. At a time when fund managers were anonymous guys in gray flannel suits, Jerry Chai was something completely different. He wasn't just a manager, he was a star.
The financial historian John Brooks just nailed it. Every era seems to have its market wizard, a guy people think has it all figured out. In the Roaring '20s, that man was Jesse Livermore. In the Go-Go '60s, it was Gerald Zai. People didn't just think he was good, they thought he had some kind of sixth sense, an almost magical ability to see where the market was headed.
So what was his secret sauce? Well, he basically took the old Wall Street playbook and threw it out the window. Forget slow and steady, buy and hold. Tsai was a gunslinger. He traded at a blistering pace, buying stocks that were already flying high, chasing momentum, and then dumping them the second they started to slow down. His portfolio turnover was over 100% a year. That means he was basically selling everything he owned and starting over from scratch every single year. His motto? Fall in love with nothing.
And you know what? For a long, long time, it worked like an absolute charm. While he was at the Fidelity Capital Fund, his numbers were just insane. From 58 to 65, his fund was up 296%. He didn't just beat the average fund, he absolutely destroyed it. This is why everyone thought he was a genius. I mean, how could you possibly argue with results like these?
So with a track record like that, what do you do next? You go big. You go out on your own. In 1965, Tsai left Fidelity in Boston, moved to New York to launch his own fund. And what happened next? Well, it can only be described as pure mania.
The public went absolutely nuts for this guy. People were practically lining up down the block, begging him to take their money. He was more than a fund manager. He was a financial rock star, the face of a new, exciting Wall Street. Buying into his fund felt like a sure thing, a guaranteed ticket to getting rich.
Initially, they planned to raise about $25 million. The demand was 10 times that. They ended up pulling in a jaw-dropping $247 million, which at the time was the biggest launch for an investment company in history. To put that in perspective, this one guy and his one fund soaked up almost 15% of all the money that went into the entire stock market that year. The hype was just completely off the charts.
So where did all that cash go? It went straight into the darlings of the era, the hottest, fastest-growing go-go stocks you could find. We're talking about companies like Polaroid, Xerox, the tech giants of their day. And these weren't cheap stocks. They were insanely expensive, trading at price-to-earnings ratios of 50, 100, sometimes even hundreds of times what they were actually earning. They were priced for absolute perfection, which means they were incredibly risky.
For a little while, it seemed like the magic would last forever. But parties always end, don't they? And as the easy money bull market that had made Jerry Tsai a star started to fade, the reversal was swift and it was brutal. Man, just look at how fast it all unraveled. In 1967, the party was still going. The fund was up almost 40%. He was still the king. 1 year later, boom, it was down 7%, and his rank It plummeted from the top of the heap all the way down to 299th out of 305 funds. The golden touch had completely vanished.
Then the bear market of 1969 arrived, and it was an absolute bloodbath for the exact kinds of stocks Tsai owned. His entire strategy, which was built for a one-way market, was left completely exposed. I mean, take one of his favorite stocks, National Student Marketing. It collapsed from $143 a share all the way down to $3.50. Wiped out.
And what was Tsai's take on all this? Listen to this quote. It's a perfect, almost textbook example of that attribution bias we talked about. He didn't say, my high-risk strategy failed. Nope. He blamed the unkind press. He saw his decade of winning as pure skill, but his one bad year? That was just bad luck and everyone being unfair. He couldn't see, or maybe wouldn't admit, that his style was designed to explode the second the market turned against him.
So, after the mania, the crash, and the finger-pointing, what's the real lesson here? What can we take away from the spectacular rise and fall of Jerry Tsai?
This analogy is just so perfect. For years, the bull market acted like bumpers in a bowling lane. Tsai could throw the ball as hard and as wildly as he wanted, and it was almost guaranteed to smack into the pins. He looked like a world champion bowler. But when the market turned in '68, the bumpers came down. And all of a sudden, every wild throw, every risky bet went straight into the gutter. And in the end, it really all comes down to this famous saying, a rising tide, a bull market, it can hide a multitude of sins. It can hide a flawed strategy, way too much risk, or just plain old dumb luck. But when that tide goes out, reality hits, and you get to see who was a real genius and who was just lucky. Jerry Tsai's genius, it turned out, was a product of his time.
And that's really the question this whole story leaves us with, isn't it? It's a question for you, for me, for anyone who's ever had a winning streak in anything. When things are going great, it's so important to have the humility to step back and ask, okay, how much of this is me and how much is just the wind at my back? Because the true test of your skill, the true test of any strategy, isn't how you do when everything is easy. It's how you hold up when the tide finally, inevitably, goes out.
All right, let's get right into it. I want to tell you a story today. It's a story that proves that even the absolute sharpest, most successful investor on the planet can fall into the exact same mental traps that get the rest of us. And this isn't just about money or stocks. It's about human nature and a blind spot that ended up costing billions. You've probably heard this quote from Mark Twain before, and it perfectly nails what we're talking about today. It's that feeling of complete, total certainty, that gut feeling that you've got it all figured out. Well, that can be the most dangerous feeling in the world. And, as we're about to see, it can be unbelievably expensive. Yeah, we're talking about the one and only Warren Buffett, the Oracle of Omaha himself, a living legend. And we are going to unpack the single biggest financial blunder he ever made, a mistake that was born from that exact feeling of knowing for sure. Now, to really get what happened here, we need to talk about a weird little quirk in our brains. It's called the endowment effect. And the idea is actually pretty simple. The second we own something, doesn't matter if it's a house, a stock, or, just a plain old coffee mug, our brain totally changes how it values that thing. It stops being about logic and what it's worth. It starts being about how much it would hurt to lose it. This was shown perfectly in this classic experiment. Researchers gave a bunch of students a coffee mug. That's it. Well, the students who now owned the mug, on average, wouldn't sell it for less than $5.25. But the other students, the buyers looking at the exact same mug, were only willing to pay about $2.25 for it. Just the act of owning it more than doubled its value in their minds. Remember that. All right, so let's set the stage. Before we get to the big mistake, you have to understand the legend of the man himself. Because Warren Buffett didn't just build a company. He built this aura of being completely invincible. The numbers, they're just staggering. I mean, look at this. Since 1962, the Dow Jones average, the market, is up about 30 times over. Pretty good. But Berkshire Hathaway, it's grown over 33,000 times. It's a number that doesn't even feel real. And if you zoom out to when he took full control back in '65, the numbers just get ridiculous. The total growth is nearly 2 million%. It sounds like a typo, right? It's a figure that's so huge, our brains can't even really comprehend it. So let's try to make sense of that. It boils down to an average return of almost 21% a year. every year, for decades. To put that in perspective for you, if you would put just $10,000 with him way back then, you'd have over $185 million today. This wasn't just luck, it was a level of genius the world had never really seen before. But here's the fascinating twist. While he was posting these completely astronomical numbers, he was the one telling everyone to calm down. He was constantly writing letters to his partners telling them, hey, this can't last, we're going to have bad years, we deserve the tomatoes when we screw up. This guy was the absolute master of caution. Which, of course, brings us to the dramatic turn in our story. How does a man who is so deeply aware of the dangers of getting cocky fall into that very trap in the most spectacular way possible? This is where we find his billion-dollar blind spot. I mean, that's the real question, isn't it? At the absolute pinnacle of his career, with all the success, all the wisdom, how did he make an unforced error that would end up costing him and his shareholders billions and billions of dollars? Okay, so picture this. The year is 1993, and the company is Dexter Shoe. They were a well-known shoe company based in Maine, made good, solid shoes. And on the surface, this looked like a classic Buffett deal. A strong American brand, seemed like it had a competitive edge that would last forever. And you just have to hear his own words at the time. Dexter, I can assure you, needs no fixing. Listen to that confidence. This wasn't a maybe. It wasn't a we think so. It was an assurance. He was absolutely 100% positive he was right. The master of caution had become the poster child for confidence. So, he struck a deal. The purchase price was $433 million. Now, that's a huge number, no doubt, but for a behemoth like Berkshire Hathaway, it's not company ending. But that price tag, that isn't the real story here, not even close. The true cost was buried in how the deal was structured. See, the massive error wasn't just buying a company whose business was about to get crushed by cheaper foreign competition. That was bad, sure. But the catastrophic part was how he chose to pay for it. Instead of cash, he used his own company's stock, a little over 25,000 shares of it. He traded a piece of his own masterpiece for this new, shiny object. And here's the gut punch. As the years went by, Dexter Shoes' business completely fell apart. It eventually went to zero. It was worthless. But those shares of Berkshire Hathaway he traded away, they did what they always do. They compounded. And they grew and grew until they were worth over $6 billion. He had traded $6 billion for nothing. Let's just lay it out plainly, because it's kind of hard to wrap your head around. What he paid was $433 million worth of his own stock. What it actually cost him, the opportunity cost, was over $6 billion. He fell victim to the endowment effect on a scale that most of us can't even imagine. He loved the company he was buying so much, he completely undervalued the incredible, world-changing asset he was giving away. But, what happened next is maybe just as important as the mistake itself. It's not about if you fall down, it's about how you get back up. And this is a masterclass in humility. He didn't hide from it, he didn't blame the economy or his advisors or anyone else. He stepped up. In his letter to shareholders in 2000, he laid it out there for everyone to see. He said, I clearly made a mistake, and then he explained exactly why it was a double whammy, compounding the error by using his own stock. And he never stopped owning it. He kept bringing it up, even years later. In 2014, he was still joking about it, calling it a financial disaster that belonged in the Guinness Book of World Records. That's what taking responsibility looks like. And this isn't some one-off thing. Get this, he has used the word mistake to describe his own actions 163 times in his public letters. Think about that. He has literally built a culture around being honest about errors, learning from them, and getting better. And that right there might be one of the biggest secrets to his success. So, what can we, regular people, take away from all this? Well, Buffett's epic failure actually gives us a really powerful and practical tool to fight that exact same sense of overconfidence in our own lives. He calls it his 20 punch card rule. Here's how it works. Just imagine that when you're born, you get a punch card with only 20 holes in it. And every time you make a major financial decision, buy a stock, start a business, whatever, you have to punch a hole. Since you only have 20 punches for your entire life, it forces you to slow down. It makes you think, really think, about every single decision. It's a fantastic way to stop yourself from making impulsive, overconfident moves. And really, that's the thought I want to leave you with. This isn't about pointing fingers at a legend. It's about learning from him. Because if the most disciplined, most successful, and most rational investor in modern history can get blindsided by his own confidence, well, that means every single one of us can too. So the question you have to ask yourself is, what's your plan to avoid that blind spot? What's your 20 punch card? What's the price of being right? Is it $1 million? $1 billion? Maybe your entire reputation? Well, today we're going to dive into a story that has all of that. It's a high-stakes financial war that really boils down to one simple question. This is a story about conviction, psychology, and let's just say, one of the most stubborn minds on Wall Street. All right, so before we get to the Wall Street titans and the billion-dollar bets, we've actually got to start with something a little closer to home. I'm talking about what's going on right up here, in our own heads. Because it turns out we all share this fundamental blind spot. You can think of it like a glitch in our mental software. I mean, seriously, think about it for a second. Why is it so hard to just say, you know what, I was wrong? It's because we don't just have ideas, do we? We treat them like they're a part of us. They become our possessions, all tangled up in our identity, our ego. So when somebody challenges one of our ideas, it doesn't feel like a debate. It feels like a personal attack. And letting go of one, especially when you've shouted from the rooftops, man, that is genuinely painful. Now check this out. This is the ideal, right? The Nobel Prize winning psychologist Daniel Kahneman says, I love changing my mind. He saw it as a joy, like making a new discovery, not a failure. But let's be honest, for most of us, that's just not how it works. We're pretty much wired to do the exact opposite, to dig in our heels. And yeah, there's a fancy psychological term for that feeling, that wiring. It's called cognitive dissonance. You know that cringy, uncomfortable feeling you get when all the evidence is piling up, screaming that you're wrong, but you can't bring yourself to change course? That's it. And let me tell you, cognitive dissonance is basically the villain of our story today. And we are about to meet a man who wrestled with this thing on a truly, truly epic scale. Okay, so now let's see how this very human, very psychological concept plays out on the world's biggest stage, thanks to a larger-than-life figure who put this exact flaw on display for everyone, and I mean everyone, to see. So let's meet our main character, Bill Ackman. You know, most smart investors, they keep their cards close to the chest, keep their financial decisions private. Not this guy. Ackman takes the exact opposite approach. He's one of the most vocal, public, and, well, aggressive investors, maybe, of all time. He doesn't just make bets, he gets on a soapbox and screams them through a megaphone. And his career, it's a classic rise and fall and rise again story. He starts his first fund, Gotham Partners, back in '93. It gets big, over $500 million in assets. And then, poof, it collapses. Just completely blows up after some bad bets. A lot of guys would be done after that, but not Ackman. He rises from the ashes, starts a new fund called Pershing Square in 2004, and comes back with an even more aggressive playbook. And really, his own words tell you everything you need to know about the guy. He said, I'm the most persistent person you will ever meet. And you have to understand, this isn't just bravado or confidence. It's a level of relentless, bulldog persistence that would become both his greatest strength and, as we're about to see, his absolute greatest weakness. So what does this guy actually do? It's important to get this. He's an activist investor. That means he doesn't just quietly buy a few shares of stock. No, he buys a huge chunk of a company. We're talking a massive stake. Then he gets on his soapbox and publicly tries to force that company to change its ways. Sometimes he'll even push to get himself and his allies on the board of directors to make those changes from the inside. It is a high-stakes, high-conflict game that requires an insane amount of self-belief. Okay, so you take all of that, the persistence, the public shouting, the aggressive strategy, and you mix it all together. And what do you get? You get the main event, his most famous, most public, and without a doubt, most brutal battle, his billion-dollar bet against a nutritional supplement company called Herbalife. So on December 20th, 2012, Ackman doesn't just, send out a press release. Oh no, he gets up on a stage and delivers a marathon 3-hour-long presentation. And get this, it had 334 slides, 334. And in it, he laid out his case, accusing Herbalife of being a massive, illegal pyramid scheme that preyed on the most vulnerable people. He didn't just go in, he went all in for the whole world to see. So one of Ackman's main points was actually pretty simple. The numbers just looked weird. He pointed to Herbalife's gross margins. That's basically the profit they make on their products before other costs. They were a staggering 80%. I mean, look at that. That's nearly double the margins of huge trusted brands like Clorox or Energizer. To a guy like Ackman, a number like that isn't just high. It's a massive, flashing red flag. And here's the next piece of the puzzle he laid out. You might think, okay, maybe their stuff is just super cheap to make. Nope, not at all. He showed that their main product, this Formula One shake, was actually 65% more expensive than similar products from competitors like GNC. So, wait a minute. How does a more expensive product, one you can't even find in a store, sell so much and make so much profit? For Ackman, the answer was obvious. The product was a sideshow. The real business was recruiting new salespeople. And then he said this. He looked the world in the eye and basically declared, "This is the highest conviction I've ever had about any investment I've ever made." Just let that sink in. He wasn't just staking his money anymore, he was staking his entire reputation, his legacy. In that single moment, he climbed so high up on that soapbox that he made it almost psychologically impossible for himself to ever climb back down. And at first, his big public crusade seemed to be working. But here's the thing about Wall Street. When you make yourself that big of a target, you invite a lot of sharks to the party. And his rivals, they could smell blood in the water. And boom, the plan worked. In just 3 days after his big show, Herbalife stock plunged 35%. It felt like immediate, total validation. It looked like he was a genius, and the company was circling the drain, headed for zero, just like he said it would. But that very public success, that panic in the market, it created a massive weakness. You see, other powerful investors looked at that panicked selling and didn't see a collapsing company. They saw a golden opportunity, a chance to buy the stock on the cheap, and more importantly, a chance to bet directly against Bill Ackman. And we're not talking about small-time players here. These were heavy hitters. First, the billionaire Dan Loeb swoops in, grabs an 8% stake, and then the big one. Ackman's longtime nemesis, the legendary corporate raider Carl Icahn, jumps in and buys almost 13% of the whole company. Suddenly, this wasn't just a bet against Herbalife anymore. This was an all-out war between Wall Street titans. And Icahn and Loeb, they used a classic brutal Wall Street maneuver against him, the short squeeze. So let me break that down. Ackman's bet, his short, only made money if the stock price went down. So what did Icahn and Loeb do? They started buying up shares like crazy, millions of them. This, of course, did the exact opposite. It drove the price up. And for every single dollar the stock went up, Ackman was losing a fortune. It was like a financial vice, and they were just tightening it day after day after day. So this war, it raged for years. And when the dust finally settled, you have to ask yourself, what was the real price of Ackman's conviction? Was he even right? And maybe the most important question of all, did being right even matter in the end? Well, in 2016, it looked like Ackman got his I told you so moment. The government, the FTC, came in and charged Herbalife with deceptive business practices. The company had to pay a huge $200 million fine and promised to restructure its business. So on paper, Ackman had been vindicated, at least partially. But here's the killer twist. It wasn't the knockout blow Ackman needed, not even close. Herbalife's CEO came out and, in a brilliant move of PR jiu-jitsu, spun the whole thing as a victory. He said the settlement was proof that their business model was fundamentally sound. And just like that, the public story was a complete mess. Nobody knew who really won. And this, right here, is the bottom line. Despite that big government fine, the stock never went to zero. In fact, it's the opposite. After 5 long years of fighting, when Ackman finally gave up and closed his bed, the stock was trading 70% higher than when he started. His public conviction, his absolute refusal to even consider he might be wrong, it ended up costing his investors nearly $1 billion. So we end right back where we started. That incredible persistence made Bill Ackman a billionaire. But that exact same trait, when you pour gasoline on it with something like cognitive dissonance, led to his biggest and most public failure. And that leaves us with a really tough question when we all have to ask ourselves, at what point does our greatest strength cross the line and become our most dangerous blind spot? Let's talk about Stanley Druckenmiller. For about 30 years, he was pretty much the undisputed king of investing, a guy who played what we call a winner's game, and get this, never had a losing year. His track record is it's staggering. But this story isn't just about his genius. Nope. It's about the one time he played a loser's game, the one time he made a catastrophic mistake that cost him billions, and in doing so taught all of us a huge lesson about the most powerful and destructive force in all of finance, our own emotions. So here's how we're going to break this down. First, we need to set the stage and define what we even mean by a winner's game versus a loser's game. Then we'll meet the man himself, Stanley Druckenmiller, and look at the incredible trades that made him a legend. After that, we get to the juicy part, the dot-com bubble, and we'll dissect exactly how he made that epic mistake. And finally, we'll pull it all together to see what we can learn from it, because this lesson, it applies to every single one of us. Okay, so to really get what happened to Druckenmiller, you first have to understand the fundamental rules of the game he was playing, a game whose rules he eventually broke. And it all really starts with this one core concept. This quote from the investing legend Charlie Ellis is basically the key that unlocks this entire story. Now, it sounds simple, right? But the difference is profound. See, a winner's game is all about skill, about making brilliant moves to score points. But a loser's game, that's won by the person who just makes the fewest mistakes. And here's the kicker. For most of us, investing is a loser's game. Ellis had this perfect analogy for it: tennis. Think about watching a pro like Roger Federer. It's beautiful, right? He wins with these incredible, precise, powerful shots. That is a winner's game. Now, picture you and me playing on a Saturday morning. The winner isn't going to be the one hitting amazing shots. The winner is just the person who screws up less, who hits fewer balls into the net. And that, right there, is how most of us invest. We're playing the amateur game. And you know what? There's actually a name for the financial price we pay for playing this loser's game. It's called the behavior gap. It's the difference between what an investment actually returns and the return the investor gets because we let our emotions get in the way. It's that classic mistake. Greed makes us buy at the top, and fear makes us panic sell at the bottom. These are the unforced errors of investing. Which brings us to our main character, a man who, for 3 solid decades, seemed completely immune to all of this. He wasn't just playing the winner's game. He was basically writing the rules at the highest level imaginable. Just try to wrap your head around this number: an average return of 30% a year. Not for a good year or a good 5 years, for 30 straight years. And this wasn't just riding a bull market either. This was through crashes, recessions, global chaos, you name it. The consistency is it's almost unbelievable. To really put that 30% in perspective, think about this. If you had invested $1,000 with the great Warren Buffett over that same time, you'd have ended up with $177,000. Incredible, right? Life-changing. Well, that same $1,000 with Druckenmiller, it would have turned into $2.6 million. I mean, it's not even the same sport. It's a different reality. And then there's this stat, the one that honestly looks like a typo: 0. In 3 decades of making aggressive, high-stakes bets all over the world, he never had a single year where he lost money. Not one. This tells you everything. He wasn't just some guy who got lucky when stocks went up. He made money no matter what. He seemed invincible. So how in the world did he do it? Well, basically by taking conventional wisdom and throwing it right out the window. You know that old Wall Street saying, pigs get slaughtered? He turned it completely on its head. His whole philosophy, which he learned from his mentor, George Soros, was simple. When you've done the homework and you are absolutely convinced you're right, you don't just take a little position. You bet big. You go for the jugular. And believe me, this wasn't just talk. It was the foundation of a career built on some of the most audacious bets in financial history. Bets that people still study today. Let's take a look at a few of the moments that made him a legend. I mean, his rise to the top was just meteoric. He was made director of equity research at a major bank when he was just 25 years old. And get this, his boss told him he was hired because he was young and inexperienced. The older guys were all too scarred from the last bear market to actually pull the trigger. They needed someone who didn't know enough to be afraid. Wild, right? By 28, he has his own fund, and a few years later, he's working for his hero, George Soros. But maybe the most incredible story about his agility happened in 1987. He had correctly turned bearish on the market as it got frothy, but then on Friday, October 16th, he made a fateful call. He thought the selling was over, And he didn't just cover his short position. Oh no, he completely reversed it, going 130% long, leveraged to the hilt, right before the single worst day in stock market history. And the following Monday, the market went into absolute free fall. A crash of over 22%. A position like the one Druckenmiller had should have been a career-ending, fund-destroying event. He was staring straight into the abyss. But this is what separates the legends from everyone else. He didn't panic. He didn't freeze. He just instantly recognized he was wrong, and he acted. By lunchtime on Black Monday, he had sold his entire long position and flipped to being short the market. And the result? He somehow finished the entire month of October 1987 with a positive return. It was just a stunning display of pragmatism and unbelievable nerve. And working with Soros, the legendary trades just kept coming. He shorted the Japanese market at its absolute bubble peak in 1989. And then, of course, came 1992, when he planned the famous bet against the British pound. He actually went to Soros and suggested they bet the entire fund. Soros's response was classic. That's not enough. We should have 200% of our net worth in this trade. So they did. They earned over $1 billion and became known as the men who broke the Bank of England. So you get the picture. He was the master, a titan. Which leads us to the central question of this whole story. How could a man like this, the ultimate professional, end up committing the most classic amateur mistake in the book? Well, it didn't happen all at once. It was a slow-motion car crash. It actually started with him being right. In early 1999, he saw the dot-com bubble for what it was and started shorting these insane internet stocks. But that led to the pain, because the bubble kept getting bigger, and being right too early meant he lost $600 million. And then the pain turned into envy. He had to sit there and watch these young traders he'd just hired make absolute fortunes on stocks he knew were total junk. And finally, he capitulated. He just broke. Overcome by FOMO, fear of missing out, he threw a lifetime of discipline out the window and plunged buying $6 billion of tech stocks, just weeks before the absolute peak. When that bubble finally popped, the result was swift and it was brutal. That single emotional play cost his fund $3 billion in just 6 weeks. It was an unforced error of epic proportions. To go back to that tennis analogy, he didn't just hit the ball into the net, he threw his racket over the fence and stormed off the court. So what on earth possessed one of the greatest financial minds ever to act like a complete novice? And what's the ultimate lesson we can take away from this spectacular self-inflicted wound? Well, Charlie Munger, as always, really puts it best. See, Druckenmiller's downfall wasn't some complex miscalculation. It was driven by one of the most basic and, as Munger calls it, stupid sins: envy. He just couldn't stand watching other people get rich on what he knew was complete foolishness. And that emotional pain just became unbearable. But the most powerful lesson here comes from Druckenmiller himself. When someone asked him what he learned from that $3 billion mistake, his answer was just brutally honest. He said, "I didn't learn anything. I already knew that I wasn't supposed to do that. I was just an emotional basket case and couldn't help myself." Think about that. It wasn't an intellectual failure. It was a total failure of emotional discipline. The master of the winner's game was beaten by a simple, amateur, unforced error. And that really leaves us with a humbling final thought, doesn't it? If Stanley Druckenmiller, a man of legendary discipline and intellect, could be brought to his knees by the raw emotion of envy, what chance do the rest of us really have? It forces us to ask, in the game of investing, is the real opponent not the market, but actually the person we see in the mirror? All right, today we're going to talk about a real giant of the investing world and how it all came crashing down. We're unpacking one of the most dramatic stories you'll find, a tale of conviction, of incredible risk, and, ultimately, of total collapse. This is the story of the legendary Sequoia Fund and its billion-dollar mistake. So let's just start with a question, because it really gets right to the heart of this whole thing. I mean, how does a legendary investment fund, one of the most respected, most successful funds, period, a fund that spent nearly 50 years building this ironclad reputation for being smart, for doing the hard work, how do they just stand by and watch their assets get sliced in half? And not just sliced in half, but because of one single disastrous bet. It's an incredible story. It shows how a real titan of Wall Street can completely stumble, and maybe more importantly, what all of us can learn from their mistake. Okay, let's get into it. Okay, so before we can really dig into the collapse, you've got to understand just how high they climbed. I mean, to really appreciate the fall, you have to see the mountain they were standing on top of. So let's talk about the legend that was the Sequoia Fund. I mean, look, Sequoia's background, it was absolutely impeccable. We're talking top tier. It wasn't just started by some random guys in 1970. No, it was founded at the personal request of Warren Buffett, the Warren Buffett. He asked them to set up a fund to manage his partner's money after he closed his first partnership. You just can't get a better seal of approval than that. It is the definition of blue chip. And they didn't just have a good reputation, they had the numbers to back it up. For almost half a century, they delivered in a way that almost nobody else has. They consistently beat the market, the S&P 500, by a whopping 2.6% a year. Now, I know what you might be thinking. 2.6%, that doesn't sound like a lot, right? But you have to remember the power of compounding. Over decades, that is a huge difference. To put it in perspective, if you'd given them 10 grand back in 1970, it would have turned into almost $4 million. Just incredible. So how did they do it? Well, it wasn't by getting lucky. It was through this obsessive, almost fanatical dedication to research. These guys weren't just traders, staring at blinking screens. They were deep dive business analysts. I'm talking, they'd study a single company for 10 years before they even considered buying a share. Here's a great example. Before they put money into O'Reilly Automotive, one of their fund directors went out and personally visited 100 different stores. I mean, that's what doing your homework really looks like. But then came 2010. And this fund, this paragon of discipline, of patience, of exhaustive research, they made a single decision. A decision that would change everything and completely torpedo their history and their reputation. And you know the craziest part? The irony of it all? Is that in the very same letter they sent to their investors, talking about how they were going to diversify more, spread the risk, they quietly introduced the one stock that would become their single biggest obsession. The one bet that would become the most concentrated, and ultimately, the most destructive thing they ever did. And we are not talking about a small position here. Not at all. At its absolute peak, one company, Valeant Pharmaceuticals, made up almost a third, of their entire multi-billion-dollar fund. I mean, that's not just putting all your eggs in one basket. That's putting all your eggs in one basket and then juggling it over a cliff. So you've got to be asking, what was this company? What was Valeant that Sequoia was willing to bet the entire farm on it? Well, here's the thing. Valeant didn't really create drugs. They didn't do a lot of that messy, expensive research and development stuff. No, their whole business model was to be a drug acquirer. They'd go out, buy up other companies that already had proven drugs, and then they'd gut the R&D budget, slash it to nothing, and then just aggressively, systematically raise the prices. To give you a really stark example, there was one treatment for lead poisoning. They took the price from about $950 to over $27,000. Now, you can imagine this whole model of just jacking up prices, it's about as far as you can get from the principles of Warren Buffett, right? The guy who got Sequoia started in the first place. Buffett himself, he even commented on Valeant's CEO later on, and he basically said, look, you want people who are smart and full of energy, but if they don't have a moral compass, that intelligence and energy is actually a really dangerous thing. And for a while, it worked. The bet was paying off. Big time. The stock was going through the roof, and the folks at Sequoia looked like absolute geniuses. But then came the fall of 2015. And it was like someone just ripped the needle off the record. The music stopped. And the collapse that followed was, well, it was breathtaking. It was fast, and it was brutal. So how did it start? With a tweet. Seriously, a single tweet from Hillary Clinton, who was running for president, calling out price gouging. That was enough to send the stock tumbling. But the real firestorm, that kicked off about a month later. A well-known short-selling firm called Citron Research, these are the guys who make money when stocks go down, they put out a report. And they didn't pull any punches. They accused Valeant of being a massive fraud. They called it the pharmaceutical Enron. And on that day, the stock didn't just fall, it went into an absolute free fall. So picture this. Your number one investment, the one you bet the house on, is completely imploding. There are accusations of fraud everywhere. Sequoia is at a huge crossroads. right? The logical thing might be to sell, cut your losses, even if they're massive, rethink everything. But that's not what they did. Nope. Instead, they came out and publicly defended the CEO, and then they started buying more. They doubled down hard. They even sent a letter to their own investors who were, you can imagine, freaking out. And in that letter, Sequoia's leadership used that famous Warren Buffett quote, "Be greedy when others are fearful." They were using their founders' words to justify buying more of this stock that was in a death spiral. They even had the nerve to compare what was happening to Valiant to a time when Berkshire Hathaway stock took a temporary hit. But here's the problem. Valiant was no Berkshire Hathaway, not even close. And this wasn't some temporary dip you buy into. From its peak, the stock just evaporated. It lost more than 90% of its value. It was a total, complete wipeout. And the damage to Sequoia? Catastrophic. I mean, this one stock basically leveled one of the most successful funds in history. In just a matter of months, their assets got chopped almost in half. They went from managing over $9 billion to less than $5 billion. And the really painful part? This was all happening while the rest of the market, the S&P 500, was actually doing fine. It was going up. So yeah, it's a dramatic story, a real train wreck you just can't look away from. But the reason we're talking about it, its real value, is in the lessons. The lessons it has for every investor, whether you're managing billions or just your own retirement account. So what do we take away from all this? Well, first and foremost, this is just a brutal lesson about the double-edged sword of concentration. You've probably heard the old saying, right? Concentrate to get rich, diversify to stay rich. And it's true. If you're smart enough or lucky enough to find the next Amazon or the next Berkshire Hathaway and you go all in, you can build incredible wealth. But the flip side of that coin is that for every big winner, there's a Valiant or an Enron, and if you bet it all on one of those, you don't just lose a little. You can get totally wiped out. So, okay, how do you stop yourself from doing what Sequoia did? How do you keep from falling in love with a bad investment and writing it all the way down? It really comes down to fighting your own brain, your own psychology. See, when Sequoia doubled down, they got trapped by these classic mental biases. There's the sunk cost fallacy, I've already lost so much, I can't sell now, so you just keep throwing good money after bad. And there's confirmation bias, where you only listen to the news that tells you you were right all along. So there are two simple but really powerful things you can do. Number one, before you ever buy a stock, write down why you're buying it. What's your thesis? What has to be true for this to be a good investment? Sequoia had a thesis for Valiant's growth? Sure, but they clearly didn't have one for what to do if it all turned out to be a house of cards. And number two, write down an exit plan. Before you buy, decide what would make you sell. A specific price, a piece of news, whatever it is. You decide ahead of time when you'll admit you were wrong. That little bit of pre-planning is your best defense against the emotion and the blind hope that destroyed them. Look, I get it. The dream of finding that one stock, that 10-bagger, that life-changing investment, it's really powerful. It's exciting. But as Sequoia learned in the most painful way possible, diversification, spreading your money around, it might feel slow. It might even feel kind of boring. But it's the only real defense against a catastrophic loss like this one. This story is just a massive blinking warning sign of what happens when that thrill of the chase completely overtakes simple discipline. So that leaves us with one final question, a question for you to think about for your own money. Just think about your single biggest investment right now, the one you feel the most confident about, the one you're sure is a winner. Now ask yourself, do you have a plan written down for what you're going to do if you're wrong? What happens if it all starts to go sideways? Something to think about. Thanks for tuning in. You ever wonder why people who have already won the game of life, completely won, why do they keep playing? That's the big puzzle we're going to dig into today. And look, we're not just talking about investing to save up for retirement. We're talking about the market as the ultimate intellectual challenge, the most addictive game on the entire planet. And our guide through this maze is the absolutely brilliant John Maynard Keynes, a man who was pretty sure he had all the answers, right up until the market proved him spectacularly wrong. To really get your head around this, just think about this for a second. A 60-year-old with $1 billion can spend over $90,000 every day, every single day, until they turn 90. They have more money than they could ever need. So why on earth are they obsessing over beating the S&P 500? Right? If investing was just about having a comfortable future, there's got to be something else going on. There has to be another reason they stay in the game. And you know what? There is. For a certain kind of person, the market isn't really about the money, it's about conquest. It is the Mount Everest of intellectual challenges. The legendary trader Paul Tudor Jones put it perfectly. He called it a game that's more exciting and more challenging than literally any other. It's this game that never, ever ends, with rules that are constantly shifting, which makes it unlike anything else out there. And this right here perfectly captures that core problem. I mean, think about it. If you're betting on a football game, the rules are fixed, the odds are published, you know what you're getting into. Investing, though, that is a whole different beast. The odds are always changing, and they're not driven by physics or stats, but by the wild, unpredictable, emotional tides of human moods, our collective greed and our collective fear. And nobody, and I mean nobody, understood this better than John Maynard Keynes. He came up with this fantastic analogy. He called it the beauty contest. He said winning in the market isn't about picking the stock you think is best. That's like picking the face you personally find the prettiest in a competition. No. The real game is about predicting which stock everyone else is going to think is the prettiest. Now, just let that sink in for a second. You're not playing the game. You're playing the other players. You're trying to read their minds. So let's get to know our main character here. And when I say genius, I don't just mean some successful investor. We're talking about one of the most towering economic minds in all of history. A man who literally shaped the world that you and I live in today. I mean, the credentials here are just staggering. He completely revolutionized how huge institutions manage their money. He masterminded the financing for England in World War II, and he was a key architect of the entire post-war global economy. Modern titans of investing, you're talking Warren Buffett, Jack Bogle, George Soros, they all point back to Keynes as a major inspiration. So if anyone could conquer this impossible game, it should have been him, right? And his genius wasn't just, some academic theory. After World War I, he saw the big picture with just terrifying clarity. He argued that crushing Germany with war reparations would only lead to economic collapse, and he predicted it would lead to vengeance. And he was, of course, tragically 100% correct. This was his style: big, top-down, macro-level thinking. But, and here's the twist in the story. When this world-class genius took his brilliant macro insights and aimed them squarely at the market, well, the market had other ideas. It decided it was time to teach the professor a lesson. Or actually, 2 lessons. So his first big try was in currency speculation. He was convinced that post-war inflation was going to crush certain European currencies, so he shorted them, which is basically just betting they'll go down, and he made a quick killing. He was so confident, in fact, that he started a fund for his friends and family. And then, in the span of just 4 weeks, a wave of market optimism that he totally didn't see coming completely, utterly wiped him out. It's just a classic example of what happens when you try to outsmart the market, a lesson that even a genius had to learn the really hard way. And then came lesson number 2. He used that same top-down approach, but this time with commodities. Tin, cotton, wheat. And when the great crash hit, his big picture view turned out to be totally useless. He lost 80% of his net worth. Let that sink in. The guy who correctly predicted the fate of entire nations couldn't predict the price of a bushel of wheat. And this wasn't just his own money. When he took over the endowment for his old college, King's College, the first few years were an absolute disaster. While the market was crashing, his fund, guided by his so-called genius, crashed even harder. This just proves that his superior intellect gave him absolutely zero edge in trying to predict short-term market swings. So here's the really crucial point of the whole story. These humbling, totally ego-crushing failures, they forced Keynes to do something that most of us never do. He questioned his entire philosophy. He realized the game he thought he was playing was fundamentally completely unwinnable, even for him. And this slide right here shows the complete 180-degree turn he made. He went from being this arrogant, top-down speculator, trading all the time, suffering from this illusion that he was in control, to being a humble, bottom-up investor, focusing on individual companies and just holding them for the long term. He totally stopped trying to forecast the entire market and instead started trying to understand the real, actual worth of a single business. And you can just hear this newfound humility in his own words. He straight up admitted that trying to guess the earnings of a railroad or a copper mine 10 years into the future is, well, it's pretty much an exercise in futility. He finally gave in to the reality that trying to make precise, long-term forecasts is a fool's errand. So, out of the ashes of all that failed speculation, Keynes built this whole new philosophy. He basically distilled all of his hard-won and, let's be honest, very expensive wisdom down into 3 core principles for successful investment. All right, here they are. First up, careful selection. Pick just a small number of investments that you can actually understand based on how cheap they are compared to their potential intrinsic value, their real underlying worth. Second, steadfast holding. And believe me, this is the hardest part. You hold them for years through all the market's crazy highs and depressing lows. And third, a balanced position. This just means managing your overall asset allocation, spreading your money across different kinds of risks so that one bad bet doesn't sink your whole ship. As he found out, it sounds so simple, but it is not easy to do. Now, let's actually look at the results. This is the before picture. Under his old speculative strategy, the King's College Fund lost nearly 50%. That's what his fancy top-down macro forecasting got him. He did significantly worse than the market. And now, wow, this is the after picture. Just look at these numbers. From 1932 to 1945, right through the Great Depression and World War II, his new principles grew that fund by an incredible 869%. The market in that same time, up just 23%. The difference is just staggering. I mean, this wasn't just beating the market, this was like playing in a completely different universe of performance. And you can see his change in behavior right here in the data. In the first half of his management, his portfolio turnover was a hyperactive 56%. In the second half, after he embraced long-term holding, it plummeted down to just 14%. He finally stopped trying to be clever and started being patient. So what does the story of this once-in-a-generation genius actually mean for the rest of us, for us mortals? Well, the lesson is profound, but it's also incredibly simple. If Keynes couldn't consistently outsmart the market in the short term, what on earth makes us think we can? Decades before anybody was even talking about behavioral economics, Keynes coined this incredible term, animal spirits. He realized that markets are often driven by this spontaneous urge to action, by gut feelings, by pure emotion and instinct, not by some cold, hard calculation on a spreadsheet. He understood that the hardest part of investing isn't analyzing the numbers, it's controlling your own behavior and surviving the behavior of everyone else. So the big takeaway for us is really about shifting your entire mindset. Stop playing that beauty contest game. Start thinking in decades, not days. Focus on your overall asset allocation, your mix of stocks, bonds, whatever else, not the hot stock of the week. And most importantly, build a portfolio that is suited to your personality, one that lets you sleep at night and get through the inevitable market crashes without totally panicking. Keynes is often credited with this quote, and it just perfectly captures his final philosophy. This whole pursuit of a perfect portfolio, timed to absolute perfection, it's a surefire path to being precisely wrong. The real goal is to build a sensible, durable portfolio that is roughly right for the long haul. And that leaves us with one last, really crucial question. It's the deepest lesson from Keynes's incredible journey, from this arrogant speculator to a humble, wise investor. Don't ask if your portfolio can beat the market. Ask if it's built to help you survive yourself. Is your portfolio built for the market, or is it truly built for you?
Being around for 45 years, you start to see a pattern. And one of the strangest things I've noticed is how people handle success. We all focus on how to handle failure. But man, handling success, that can be a whole lot harder. It's one thing to chase that life-changing win, but it's a completely different ballgame to know what to do after you've actually won.
Let's start with this little piece of wisdom from way back in the 17th century, because it perfectly sets the stage for one of the most incredible and, cautionary stories in modern finance. It sounds so simple, right? Quit while you're ahead. But, as we're about to see, it might just be the hardest piece of advice in the world to actually follow.
I mean, we all have that dream, don't we? That one big score that changes everything. But the reality? It's often a curse. Just look at this. Almost a third of lottery winners end up completely broke. Think about guys like William Bud Post III. He won $16.2 million in 1988 and died on Social Security. That sudden flood of cash can be way more destructive than the struggle that came before it. So today, we're going to follow the story of a man who didn't just win the financial lottery, he engineered it. He did it with a rare mix of skill, sheer conviction, and incredible timing. But the real lesson, the one that sticks with you, isn't in the winning, it's in what happened after. We're going to break it all down in these 5 chapters.
Okay, first things first.
let's get into the psychology of what it means to win big. Because let's be honest, in a world that feels more and more like a giant casino every day, you gotta understand this stuff.
So here's the real problem, the fundamental trap. In the markets, money you make from pure, dumb luck looks exactly the same as money you make from being a brilliant strategist. Your brokerage account doesn't have a little note next to your balance saying, "Congrats, you got lucky." It just shows the number. And that creates this really dangerous illusion that makes you think you're a genius when maybe you just caught a lucky break.
And that leads to this powerful thing psychologists call the house money effect. You know the feeling, right? When you win big, those profits don't feel like your money. They don't feel like the cash you grinded for. It feels like you're playing with the casino's chips. And what do you do with house money? You let it ride. You make bigger, crazier bets, hoping that lightning's going to strike twice.
So with that psychological trap in mind, let's meet our main character, John Paulson. Back in the early 2000s, this guy was a nobody, at least in the world of superstar investors. His hedge fund, Paulson & Co., specialized in this really kind of boring strategy called merger arbitrage. He wasn't a big shot, but he was about to make a move that would change absolutely everything.
So in the mid-2000s, while literally everyone else was flipping houses and getting rich, Paulson and his analysts saw something that almost everyone was just ignoring. They saw that the U.S. housing market was showing signs of pure, unfiltered insanity. I'm not kidding. We're talking about lenders accepting a photo of a mariachi singer in his costume as proof of income, or strawberry pickers getting mortgages where the monthly payment was basically their entire salary. It was nuts.
And it wasn't just crazy stories. The hard data was screaming it from the rooftops. For a quarter of a century before the year 2000, housing prices just kind of puttered along, basically tracking inflation at 1.4% a year. But then, during the bubble, that rate shot up to 5 times the normal average. I mean, that's a massive, flashing, red light warning that the whole market had just completely lost its mind.
Okay, so with this deep, unshakable conviction, Paulson decided to make a bet against the entire U.S. housing market. A move so bold, so against the grain, that people would later call it the greatest trade ever.
But there was a catch. You can't just call your broker and say, "I want to short sell 1 million houses." So Paulson had to get creative. He found his weapon of choice in this really complex thing called a credit default swap, a CDS. The easiest way to think about it is like an insurance policy. Paulson basically went to the big banks and started paying them a regular fee, a premium, to insure bundles of these awful mortgage bonds. He was betting that people would stop paying their mortgages, the bonds would go to zero, and the banks would have to pay him out, just like an insurance company after a disaster.
But here's the thing about being right. It doesn't mean you make money right away. His timing wasn't perfect. For more than a year, he was losing money, month after month after month, just bleeding cash, paying the premiums on these insurance contracts while the market just kept going up. You can imagine his investors were getting pretty antsy, and the whole world was basically telling him he was an idiot.
And this, right here, this is the real price you pay for being a true contrarian. It's not just about disagreeing with people. It's about having everyone you respect, all the so-called experts, look you in the eye and tell you you're insane. Big shot analysts were telling him his models were wrong. It takes an incredible amount of guts to hold your ground against that kind of pressure. But then, in 2007, the cracks started to appear. And then the whole rotten thing came crashing down. And when the market finally imploded, Paulson's main fund gained a mind-blowing 590%.
In total, his firm, Paulson & Co., made a historic $15 billion from that one single trade. It's a number so huge, it's almost impossible to really wrap your head around.
And what was his personal cut? $4 billion. In 1 year. To this day, it's the most anyone has ever made in the history of finance. He'd done it. He had won the game. So Paulson had won the financial Super Bowl, the World Series, and the lottery all rolled into one. But the story doesn't end there, because now he had to face a new and way more dangerous opponent, his own success.
This quote just says it all, doesn't it? It perfectly explains his mindset. He had just climbed the highest mountain in finance, and the only thing he wanted to do was find an even bigger one to conquer. Normal wins just wouldn't cut it anymore. He was chasing that high again, that feeling of being the only person in the world who saw the truth.
So he made another huge all-in bet, this time on gold. He was convinced that all the government bailouts would cause hyperinflation, so he just plowed billions into gold. But this trade, it was totally different.
The housing bet came from years of painstaking, specific research. The gold bet? It was a big, general idea driven more by ego and the desire for another grand slam than anything else.
And the result was an absolute disaster. The massive inflation he was so sure about never happened. Gold prices tanked. His main fund lost over a third of its value in a single year. Another, more aggressive fund lost almost half. His company's assets, which had peaked at an incredible $36 billion, just collapsed, shrinking by nearly 75%. The magic was gone.
So, after all that, what's the big lesson here? What can we learn from a guy who reached the absolute summit only to give so much of it right back?
The whole point, the most crucial takeaway is this. Once you've won the game, the rules have to change. Your goal isn't to hit more home runs, it's just to not get struck out. The whole objective has to shift from winning more to simply not losing what you already have. You only need to get rich once.
It sounds so simple, but man, it is profoundly difficult to actually do. That desire for more, that craving for the adrenaline rush, that belief that you can make lightning strike twice, it's a powerful pull. Which leaves all of us with a really tough question to think about, not just in investing, but in life. If you really truly won, if you had everything you ever needed, could you get up and walk away from the table?
All right, let's just jump right into it. We've all had that dream, right? Finding that one investment, the one that just completely changes the game for us, the one that delivers those truly life-altering returns. But here's the thing we almost always forget. The biggest rewards in the market, they almost always come with a hidden and, let's be honest, a pretty terrifying price tag. So let me ask you this directly. What do you think the real cost of a 38,000% return is? Now I know, it sounds like a trick question, but the answer really gets to the very heart of what it means to be a successful long-term investor. So let's start with that number, because it's just staggering. 38,600%. That is the actual return Amazon has given its shareholders since its IPO way back in 1997. It's the kind of number that makes you wish you had a time machine, doesn't it? I mean, think about it. A single $1,000 investment would have turned into almost $400,000. But, and this is a really, really big but, to actually get that gain, you didn't just have to be smart enough to buy the stock. Nope. You had to be tough enough to hold on through this. A 95% loss. Let that sink in. Between 1999 and 2001, Amazon lost almost all of its value. That $1,000 you invested, which had ballooned to over $54,000, would have shrunk all the way back down to just $3,000. Now, ask yourself, and be honest, could you have watched that happen and not sold? Could you have held on through that kind of gut-wrenching, soul-crushing volatility? Most people can't. They just can't. And look, this isn't some weird one-off Amazon story. This is the pattern. This is how it works. Take Netflix, for example. It's been a phenomenal investment, right? Compounding at 38% a year since its IPO. But the price of admission for that incredible ride was surviving an 82% drop between 2011 and 2012. Just imagine watching over 4/5 of your investment value, poof, just evaporate into thin air. Even a supposedly smoother ride like Google, well, it was anything but smooth. It only got cut in half once, losing 65% of its value during the 2008 financial crisis. Now get this, during that fairly short period, the stock was turned over 5.5 times. You know what that means? It means most of the original investors got scared, they got shaken out, and they missed the 515% gain that came right after. And this is the point we have to keep coming back to. This gut-wrenching volatility, it isn't a flaw in the system, it is the price of admission. It's the fee you have to pay for big returns. And that brings us to the man who absolutely mastered the mental game. The guy who figured out how to not just survive this kind of pain, but to actually thrive in it. The one, the only, the legendary Charlie Munger, Warren Buffett's longtime partner. You see, Munger's genius wasn't just in picking stocks, it was in his whole way of thinking about problems. He was famous for something he called inversion. So instead of asking, how can I succeed, he would flip the whole problem on its head and ask, okay, what are all the dumb things I could do that would guarantee I fail? And then he would just make it his life's mission to avoid those things. This quote just sums it up perfectly. All I want to know is where I'm going to die, so I'll never go there. Simple, but brilliant. And this philosophy of just avoiding stupidity led to his famously simple way of making decisions. He said he had 3 baskets for any potential investment: in, out, and too tough. Now, if a decision was really complex, or if it was outside his area of expertise, he didn't try to be a hero and figure it out. He just threw it in the too tough basket and moved on. Think about the psychological freedom in that. No ego, no fear of missing out, just a relentless, disciplined focus on what you actually understand. And this story is just perfect. It illustrates exactly how he viewed the financial industry. He tells the story about seeing these ridiculously flashy, colorful fishing lures. And he asks the seller, "My God, they're purple and green. Do fish really take these lures?" And the seller's reply says everything you need to know. "Mister, I don't sell to fish." Munger's whole point is that so much of the financial world is designed to catch investors, not to help them catch profits. He just knew to stay away from the shiny purple and green lures. But here's the thing. Munger's wisdom wasn't just theoretical. It wasn't learned from a book. No, it was forged in the fire of one of the worst bear markets in history, a period that nearly ruined him and taught him his most valuable and painful lessons. I mean, just look at this timeline. You can see the whole story unfold. In 1962, Munger started his own investment partnership, and for a while, man, he seemed unstoppable. He was on fire. For the first 8 years, he averaged a mind-boggling 37% annual return, absolutely crushing a market that was basically going nowhere. He looked like an absolute genius. But then 1973 hit. The world changed. A brutal bear market kicked in, and the fund that had been his greatest success story quickly became the source of his greatest pain. Now look at these numbers. It's just brutal. In 1973, Munger's fund lost almost 32%, while the Dow was down only 13%. The next year, he lost another 31.5%. The very same concentrated strategy that created those incredible gains on the way up was absolutely devastating on the way down. He later said it was a very unpleasant stretch. Yeah, that might be the understatement of the century. Let's put this in perspective. If you had invested $1,000 with the great Charlie Munger at the start of 1973, just 2 years later, your investment would have been worth $467. He lost more than half of his investors' money. And this experience, it left him so emotionally drained that he shut it all down. He liquidated the partnership and walked away. So how in the world could one of the greatest investment minds of all time get hit so hard? And, maybe more importantly, what did he learn from it? Munger's trial by fire, it really gives us a masterclass in the psychology of handling these massive, inevitable downturns that we all face. Okay, first, let's just quickly define a key term you're going to hear a lot, drawdown. It's just a fancy way of saying the decline of your investment from its highest peak down to its lowest point before it starts climbing back up again. Munger, as we saw, experienced a massive, massive drawdown. Now, Munger's really painful experience teaches us that there are two different types of loss in investing. The first one is absolute loss. That's pretty straightforward. His fund lost 53% of its value. That's the number you see on your statement. But the second one, relative loss, man, that can be even more psychologically damaging. That's when you're losing money while it feels like everyone else is getting rich. The perfect example is the late 90s, when Berkshire Hathaway dropped 49%, while the tech-heavy NASDAQ was soaring 270%. The pressure to just give up on your strategy and chase what's hot, it becomes almost unbearable. And it's that immense psychological pressure, especially from relative loss, that led Munger to his most famous conclusion of all, that long-term investing success, it has very little to do with your IQ. It's all about temperament. It's about forging the mental fortitude, the toughness, to stick with your plan when every fiber of your being is screaming at you to panic and sell. This right here might be one of the most important quotes in all of investing. It's the core lesson for today. He is telling us straight up that 50% drops are not some weird once-in-a-lifetime event. No, they are a normal, recurring, absolutely guaranteed feature of being an investor. And if you are not prepared to handle that reality with a calm, philosophical mindset, with what he calls equanimity, then you simply don't deserve the incredible rewards that come from owning great businesses over the long term. And that really is the secret sauce, isn't it? Munger never claimed that he and Buffett were the smartest guys in the room. He said their results were so good because they have a temperamental advantage. They are able to stay rational when everyone else is losing their minds. And that emotional control, that discipline, it more than makes up for any perceived lack of genius-level IQ points. So, okay, how do you actually build this kind of temperament?
Well, it starts with being brutally honest with yourself. So let's do a simple but really powerful exercise right now. First, start with your total portfolio value. Then, and this is the hard part, decide on the maximum dollar amount you could lose without totally freaking out and selling everything. Now, the most important part, assume stocks can get cut in half, because they can and they will. You divide your maximum tolerable loss by that 50%. The result is the absolute maximum amount of your portfolio that should ever be in stocks. You see what you're doing? You're not trying to predict the market. You're aligning your portfolio with your own psychology, and that is so much more important. Because here's the ultimate takeaway from all of this. The goal is not to be a genius who avoids all losses. That is a fantasy. It's impossible. The real goal is to build a portfolio and to build a mindset that ensures you are never a forced seller at the absolute bottom. It's about being able to endure the storm so you can be there for the sunshine that always, eventually, follows. Which brings us right back to that first question. A 95% drawdown, an 82% drawdown, a 65% drawdown. These aren't aberrations. They aren't mistakes. That is the price of admission for extraordinary long-term returns. So the only question left to ask is, now that you know the real price, are you willing to pay it? Let's talk about Chris Sacca, one of the biggest names in venture capital. But this isn't just about his billion-dollar wins. Nope. We're going to dig into something that affects every single one of us, a feeling so powerful it can drive every decision we make. Regret. You'd think, right? Billions of dollars in the bank, you probably sleep like a baby. But let me ask you this. What if the wins aren't the whole story? What if the things that really haunt you aren't the successes, but the absolute game changers you let slip right through your fingers? So picture this. The founders of Dropbox are right there, in front of you. Super simple idea, right? File sharing in the cloud. But your brain just screams, how can these guys possibly take on a giant like Google? So you pass. A single decision that, by his own account, cost him hundreds of millions of dollars. Okay, so next up, the Airbnb guys walk in. Their pitch? Hey, let's have total strangers sleep in your spare bedroom. What's your first thought? Well, Sacca's was pretty visceral. He thought somebody was gonna get raped and murdered. He literally told them their idea was just fundamentally unsafe. Hard pass. And then, of course, you've got Snapchat. At the time, it just seemed like a silly little fad, right? An app for sending, well, photos you didn't want sticking around. Sacca just couldn't see beyond that. He couldn't imagine it would become a global communication powerhouse. So that's another pass. Just think about that for a second. 3 of the most defining tech companies of a generation. And he said no to every single one. So to really get what's going on here, you've got to understand the sheer scale of these misses. We're not talking about small oopsies. These were companies that basically defined an entire industry. And I mean, listen to the man himself. This isn't just about numbers on a spreadsheet for him. It's a real, genuine, emotional weight. It just goes to show you no amount of money or success can protect you from that nagging, powerful voice of regret. Even with all his incredible wins, the ghosts of these missed opportunities are very, very real. So remember that unsafe idea he passed on? Well, here's Airbnb's valuation today. Over $30 billion. Yeah, it turns out people were perfectly willing to stay with strangers. It wasn't just a weird idea, it was a complete revolution in travel that he just totally missed. And how about that silly little app for disappearing photos? Snap went public with a valuation of $24 billion. It completely tapped into how an entire generation talks to each other. It became a massive cultural force that just slipped right through his hands. And Dropbox, the little startup he was so sure would get crushed by Google, well, they found their lane, they exploded, and now they're worth around $10 billion. These aren't just companies, they're entire ecosystems of innovation. He had a front-row ticket to all of it, and he chose to get up and walk away. So the big question is, how does a guy this brilliant make mistakes this huge? The answer has nothing to do with intelligence. It's all about psychology. See, it turns out we're all walking around with ancient mental software that is hopelessly out of date for the world of modern investing. Let's put this into perspective, because this is wild. If you squished the entire 2 million year history of humans into a single 24-hour day, modern investing theory wouldn't even show up until the last 2 seconds before midnight. 2 seconds. Our brains didn't evolve to price a software as a service company. They evolved for one thing: survival. Is that a saber-toothed tiger in the bushes, or is it just the wind? That programming is fantastic for staying alive, but it is absolutely terrible for valuing a startup. And this
This is the little cognitive trap that makes regret so painful. It's called hindsight bias. Looking back now, it feels completely obvious that Airbnb and Snap were going to be huge, right? Of course they were. Well, that's this bias tricking your brain. It rewrites history and makes you feel like you knew it all along. And that's what turns a simple mistake into this agonizing personal failure. That feeling is regret. And check this out. This really shows you how much our emotions cost us. There was a study where researchers had people with specific brain damage, the kind that actually limits feelings like fear and regret, play an investment game. And guess what? They consistently made more money than the normal players. Why? Well, without all that emotional baggage from past losses or the fear of future regret, they were just free to make more logical high-reward bets. Our feelings, it turns out, can be a serious financial liability. And hey, if you think Chris Sacca has it bad, just imagine being Ronald Wayne for a second. He was the third co-founder of Apple. Back in 1976, he got nervous and sold his 10% stake in the company for $800. Today, that same stake would be worth over $900 billion. That's a B. It's a single decision that cost him more money than almost anyone on this planet can even fathom. Okay, I know what you're thinking. After hearing about all these monumental screw-ups, how on earth did Chris Sacca become a billionaire in the first place? Well, because for every swing and a miss, there were a few times he connected with the ball and hit it into the next galaxy. And I am not exaggerating here. Sacca's first fund has literally been called possibly the most successful fund in the history of venture capital. His early investors saw their money multiply by 250 times. To put that into perspective for you, to get that kind of return from Apple stock, you would have had to buy it way back in 1998. He wasn't just finding good companies, he was finding the legends. So let's look at the numbers. In investing, getting a 10-bagger that's 10 times your money is like the dream. It's the holy grail. Sacca, well, he wasn't even playing the same sport. Instagram returned 50 times his investment. Twitter, an incredible 3,000 times. And Uber delivered a staggering, mind-blowing 5,000 times his fund's original investment. These aren't just home runs. They are game-winning, season-defining grand slams. Let's just focus on that Twitter investment for a second. That 3,000 times return reportedly translated into $5 billion for his investors from one single bet. And this is why he can afford to have those nightmares about Dropbox. His winners were so astronomically huge that they made the misses look like rounding errors. And this quote, this gets right to the heart of his entire philosophy. He is totally open about his mistakes. He gets that in his world, you're going to swing and miss a lot. It's not about being right all the time. It's about being right big just a couple of times and then having the guts to let those winners run. Okay, so what's the big takeaway from all this? We've seen a billionaire's biggest regrets. We've looked at the flaws in our own brains, and we've seen his epic wins. So how can we actually apply this stuff to our own lives and stop being paralyzed by regret? This quote from Harry Markowitz, this is the guy who won a Nobel Prize for basically inventing modern investing. And his words here are everything. Notice what he said. He didn't say his goal was to eliminate regret. He knew that's impossible. The real goal, the only one you can actually achieve, is to minimize it, to build a system that protects you from the worst parts of this really destructive emotion. So how do we actually do that? Well, here's a pretty simple 3-step plan. First, you've got to recognize your triggers. You have to know that regret is going to hit you hardest at the emotional extremes, right after a huge win or a painful loss. Second, avoid thinking in absolutes. It's never all or nothing, and that leads right into the most important step. Number 3, sell some. Honestly, this last step is a bit of a psychological hack, and it's brilliant. By selling just a piece of your investment, you basically engineer a mental win-win for yourself. Think about it. If you sell 20% and the stock doubles, you don't beat yourself up. You think, great, I've still got 80% in the game. But if the stock gets cut in half, you also feel smart. Great, at least I sold some of it. You've created a situation where you get to feel good about your decision no matter what happens next. So I'll leave you with this final question to think about. What's your personal trigger for regret? Is it the fear of missing out on even bigger profits, that FOMO that makes you sell out way too early? Or is it the fear of admitting you made a mistake, which makes you hold on to a losing position for way, way too long? Knowing the answer to that question for yourself, well, that's the first and most important step to finally taming that old Stone Age brain of yours. You know, in investing, we spend so much of our time analyzing everything out there. companies, charts, economic data. But what if the single most important variable, the one we almost always forget about, is the person staring back at us in the mirror? This explainer is all about that reflection and why it might just be the key to everything. The financial writer Jason Zweig absolutely nails it with this quote. It's so easy to look at behavioral finance as this window, right? A way to see all the crazy, irrational things other people are doing with their money. But the real work, the really hard part, that's turning it around and using it as a mirror, holding it up to our own decisions, our own biases, our own screw-ups. And, to really get a feel for how powerful that mirror can be, we're going to dive into the story of Michael Batnick. I mean, this guy didn't just make a few bad trades. He managed to pack a lifetime's worth of mistakes, both in his personal life and in the market, into just a few short, brutal years. And that's exactly what makes his story such a powerful lesson for the rest of us. I mean, just look at the cold, hard numbers here. It's brutal. In 2012 alone, he paid $12,000, not in losses, in commissions, just from churning his account over and over. So he thinks he's learned his lesson, tries a so-called long-term approach the next year, and loses another $12,000. And he did this in a year the market was up 32%. You almost have to try to lose money in a market like that. So you gotta ask yourself, where does a story like this even begin? Well, it starts right here, with this number, 1.1. That was his GPA in his second semester of college. And look, that's not just a bad report card. That's a 5-alarm fire. It's a signal that he was just completely, totally adrift. And if you think that number's bad, well, this is how far off the rails he really was. I mean, he wasn't just put on academic probation. He was kicked out of school, summarily dismissed, and not just once, twice. He talks about hitting rock bottom, sitting in the car with his dad at 20 years old, just feeling completely humiliated with absolutely no idea why he'd failed so spectacularly. So after finally somehow scraping his way through college, he steps out into the professional world. But the learning was far from over. He calls this next phase of his life paying tuition to the School of Hard Knocks. And let me tell you, the tuition was steep. So his big dream of working on Wall Street, well, it started right here. But the reality was, well, it was a world away from Wall Street. It was a commission-only job selling insurance to his friends and family. No salary. And get this, not only did he not get a salary, he actually had to pay rent for his own desk. Can you imagine? After 18 months, he'd sold almost nothing. It was just a miserable, soul-crushing dead end. So yeah, he quit. Who could blame him? And this is where things get interesting. The same guy who couldn't even be bothered to show up for class in college, he completely transforms himself. He becomes what he calls a laser-focused learning machine, spending every single day parked in the library, trying to soak up everything he possibly could about finance. He was a man on a mission. Now, right in the middle of all this intense self-study, something terrible happens. His mother passes away, and she leaves him an inheritance. And what does he do with that money? Well, he discovers these things, 3x leveraged ETFs. Look, let's be clear, these are not your grandpa's index funds. These are basically financial weapons of mass destruction, designed to triple the daily moves of an index, which is great when it goes your way and absolutely catastrophic when it doesn't. He puts it perfectly himself. There's really no better way to say it. This had nothing to do with investing. It was pure speculation. In his words, legal gambling on steroids. His strategy, if you can even call it that, was just to pick one, buy it, and pray it went up. So why? Why was he trading like a maniac? It really boils down to this classic cognitive bias we all fall for, the illusion of control. He genuinely thought that by clicking buttons all day, by constantly buying and selling, he was somehow in the driver's seat, that he was controlling his own destiny. But the irony is just brutal, isn't it? The only thing he was a hostage to was his own bad thinking. You know the old-school financier Bernard Baruch? He just summed up the sheer insanity of this game perfectly. To pull this off consistently, to time the market, you'd need this superhuman combination of skills. And even if you had all that, all you've got is a ghost of a chance. Batnick was starting to figure out he was playing a rigged game. So, okay, he finally realizes that day trading is a dead end. He decides to try and get a real, proper job in finance. But the industry, well, it wasn't exactly rolling out the red carpet. This next phase was just one brutal rejection after another. He calls them his 3 failed auditions. And I mean, these weren't just the thanks but no thanks emails. These were soul-crushing. First, after all that work studying, an interviewer tells him that his CFA charter is actually a mistake for the sales job he wanted. A mistake. Then he gets a dream job offer, only to have it pulled back because of some minor blemish on his credit report from his college days. And the final straw? An interview for a job that wasn't even in finance. It lasted 3 minutes. 3, before they basically showed him the door. I mean, can you imagine? This was it. Rock bottom. Again. He really started to doubt everything. He was thinking, you know what? Maybe I'm just kidding myself. Who do I think I am trying to do this? Maybe it's just time to grow up and get a real job. He was mentally checking out. And then, right then, when he was basically at the end of his rope, about to throw in the towel for good, something happened. It was this bizarre moment where all those years of failure and preparation just slammed right into a totally random, meaningless event, a dead phone battery. Okay, so picture this. He's at a Knicks game and he gets yet another rejection email. Of course, the Knicks are getting destroyed, so he just leaves early, feeling totally defeated. He's on the late-night train back home, just doom-scrolling on his phone, and then pop, the battery dies. It's such a small, random thing, right? But because it died, he had no choice but to look up from his screen. And what happens next? Well, it brings up a really interesting question. Was this just pure, random, dumb luck? A 1 in a million shot? Or was there something more to it? See, because he looked up, he saw a guy walk right past him. A guy he recognized, Josh Brown, a pretty well-known financial writer he followed. This was it, the moment of truth. He could have just sat there, frozen, let the moment pass. But he didn't. He made a choice. He got up, walked over, tapped him on the shoulder, and just told him a story. And he walked off that train with a business card. That one single act of just going for it, it changed his entire life. So yeah, that chance meeting on the train, it led to a job, and that job led to a real career. But honestly, the happy ending isn't the most important part of this story, not even close. The real gold is in what he learned from all that pain, all that failure along the way. And you can see that transformation right here. It's just a night and day difference. He went from trying to be this market wizard, trading options, thinking he could outsmart everybody, to becoming the common sense investor. He finally just embraced humility, discipline, the kind of long-term common sense wisdom you get from guys like Jack Bogle. He stopped chasing alpha and started building a real business. So, when you boil it all down, what are the big lessons here for us? Well, first, luck is a huge part of life. A huge part. But you have to put yourself in a position to get lucky. You have to make your own luck. Second, and this is so important, the market does not care about you. It's completely impersonal. It doesn't know your goals. It doesn't care about your timeline. And third, this one's just a fundamental rule of the road. If you need money in the next few years for a down payment or anything else, it does not belong in the stock market. Period. And all of this kind of brings us to the big takeaway. The great Peter Bernstein said it best. Mistakes are an inevitable part of the process. They're not just something that might happen. They are going to happen. It's part of the deal in investing and in life. So, the real difference maker. It's not whether you make mistakes or not. Everybody does. The question is, what do you do with them? The great ones, they learn from them. They grow. They get better because of their mistakes. Other people, they just get set back by them. And that brings us right back to where we started, to that mirror. So the real question for all of us is, what happens when you finally take that hard, honest look? When we think about the greatest investors, we always focus on their home runs, right? Their legendary wins. But what if I told you the real secret, the most valuable lessons, are actually buried in their spectacular billion-dollar failures? It sounds a little crazy, I know, but the smartest minds in finance are often defined by their biggest screw-ups. So let's get into this, because what we're about to uncover completely shatters that myth of the perfect, infallible investor. And we're going to start with, of all people, Mark Twain. Now, we all know him as a literary genius, but he was also a wildly optimistic and pretty terrible investor. This quote, this wasn't just some witty observation. Oh no, this was a lesson he learned the hard way. after losing what would be millions today on these futuristic inventions that just completely went bust. He found out that being a genius in one area doesn't mean you're a genius in the market. And that, right there, perfectly sets the stage for everything we're about to discuss. And that's really our first big idea here. This section is all about showing you that the titans of finance, the household names, the ones you think never make a wrong move, are, well, surprisingly human, and maybe even reassuringly so. I mean, just look at this. On one side, you have the legend himself, Warren Buffett, the Oracle of Omaha, a name that's basically synonymous with investing success. But on the other side, you have a mistake so massive, he himself has called it his worst ever. Back in '93, he bought a company called Dexter Shoes. But here's the kicker. He paid for it using Berkshire Hathaway stock. The shoe company, it went to zero. And that stock he used to buy it, today, it's worth billions and billions of dollars. It was an absolute, unmitigated disaster from the best in the business. And you know what? This wasn't some one-off thing. Buffett's own mentor, the great Benjamin Graham. I mean, this is the guy who literally wrote the book on value investing. He was incredibly open about his own huge blunders. He actually believed that studying failures was essential. So right from the very beginning, from the founding father of this whole discipline, making massive mistakes isn't some weird exception. It's practically part of the job description. So this leads us to the big question, the one we're really trying to answer here. If the absolute best and brightest, people who have spent their entire lives mastering this craft, can get it so spectacularly wrong, what is it? What are the hidden tripwires? What are the universal traps that can catch even a genius? Well, it turns out the answer usually boils down to two incredibly powerful forces. Two traps that can derail any investor, no matter how high their IQ. The first is intellectual hubris, and the second is just basic, messy human psychology. Let's break those down. Okay, first up is what I call the genius trap. You would think that being brilliant is the ultimate defense, right? But history shows it can actually be a huge liability. Sir Isaac Newton, one of the smartest human beings who ever lived, got absolutely wiped out in a market bubble. John Maynard Keynes, the economist who shaped modern governments, nearly went bankrupt, not once, but twice. And maybe most famously, a couple of Nobel Prize winners started a hedge fund that blew up so spectacularly it almost took the entire global financial system down with it. Yeah, let's just take a closer look at that fund, Long-Term Capital Management, or LTCM. I mean, this timeline is just jaw-dropping. It's founded in '94 by an absolute dream team of academics and traders. By '97, its founders are literally accepting the Nobel Prize for their financial models. The fund is making mind-blowing returns, and then, just 1 year later, poof, it completely collapses, losing over 90% of its value and forcing the Federal Reserve to step in and organize a massive bailout. They were so convinced their models couldn't be wrong that they completely missed the one black swan event that proved they were. So if pure brain power isn't the answer, what is? Well, the other major trap is much more primal. It's got nothing to do with complex math. It's all about the wiring in our own heads. You see, the failure of LTCM wasn't just a miscalculation. It was a fundamental failure to account for raw human panic and fear in the markets. And this brings us to this incredible field of study, behavioral biases. The pioneers here were these two psychologists, Daniel Kahneman and Amos Tversky. And what they discovered is that our brains are not these cold, rational computers we like to think they are. Nope, they're running on ancient survival software, full of these little mental shortcuts that help us make quick decisions. And while those shortcuts were great for, not getting eaten by a tiger, they are absolutely terrible for navigating the complexities of modern financial markets. They create systematic, predictable errors in our judgment. And here are just a few of the big ones that trip up everybody, even the pros. You've got loss aversion. Psychologically, the pain of losing $1 feels about twice as bad as the pleasure of gaining $1. That's what makes us sell our winners way too early and cling to our losers way too long. Then there's the endowment effect, which is this weird quirk where we overvalue something just because we happen to own it. There's also hindsight bias. That's the I knew it all along feeling you get after something happens, which makes us way overconfident. And finally, my favorite, animal spirits. Keynes coined that one. It's just that primal wave of fear or greed that can wash over a market and make everybody forget logic. And trust me, no amount of intelligence makes you immune to these things. All right, so we have our two main culprits, being too smart for your own good and being, well, human. Now let's take a quick tour through a gallery of other legendary failures and see these exact forces at play. We're going to see some famous names here. First up, Jesse Livermore, the boy plunger. He was one of the most famous market speculators of all time. This guy made and lost several fortunes, but his final complete undoing was a huge, leveraged bet on cotton that went south and completely wiped him out. The tragic part is, he broke his own rules. He let his ego and his hope cloud his judgment until he had nothing left. It's a classic cautionary tale of overconfidence. And we're back to our old friend Mark Twain. He poured his entire fortune and his wife's into what he was sure was the next big thing, this incredibly complicated typesetting machine called the Page Compositor. It was an engineering marvel, sure. It had over 18,000 individual parts. But as a business, it was a total disaster. It was too complex, it was too expensive, and it was always breaking down. He just fell in love with the idea and ignored all the flashing red lights. It was a money pit that cost him absolutely everything. Even a master of the universe like George Soros isn't immune. After his legendary, brilliant bet against the British pound, the one that earned him the title The Man Who Broke the Bank of England, his fund made a massive bet on Russian markets in the late 90s. Then, Russia defaulted on its debt. The result? A staggering loss of over $1 billion. It was just a humbling reminder that no matter how right you've been in the past, the market can always prove you wrong tomorrow. Now, this one's a little different because it's what they call a mistake of omission, and sometimes these are the ones that sting the most. Chris Sacca was a genius at spotting early-stage tech companies. He got into Twitter and Uber when they were just starting out, but when the founders of Dropbox came to him for money, he passed. He thought the market was already too crowded. He later called that decision a multi-billion-dollar non-investment. It's proof that sometimes the costliest mistakes aren't the things you buy, but the things you see and then fail to act on. And finally, here's a story I love because it's about how failure can actually lead to triumph. This is John Bogle, the man who would go on to create Vanguard and the indexed fund, revolutionizing investing for millions of regular people. While early in his career, he was fired. Fired. Why? Because he championed this big merger at his firm, Wellington Management, that turned out to be a complete and utter disaster. But you know what? Getting fired was the catalyst. It pushed him to go out and build his own revolutionary company from the ground up. So, wow, we have seen the mistakes. We've toured the wreckage, and honestly, it can feel a little bleak. But the good news is that inside these stories of failure, you can actually find the seeds of a solution. So, what are the big lessons? How do we build a defense against these powerful forces of error? Well, the antidote isn't some magic formula. It's a framework. It's a process designed to protect you from your worst enemy, yourself. It starts with step 1, Buffett's famous advice. Know your circle of competence. If you don't truly understand an investment, just stay away. Step 2, from Benjamin Graham. Always demand a margin of safety. That means creating a buffer by buying an asset for way less than you think it's actually worth. Step 3 is all about obsessing over risk management, focusing first on not losing money rather than on how much you can make. And finally, step 4. You have to have a process, a system, a checklist, something to keep your own emotions and biases from running the show. And if you ever need a reason why that framework is so critical, this chart should do it. This is the real cost of ignoring those rules. This is the price of overconfidence. These aren't just abstract percentages. A 90% loss, like LTCM suffered, means you need to make a 900% return just to get back to where you started. These aren't setbacks you can just shrug off. These are the kinds of mistakes that end careers and completely wipe you out. Which brings us to this little piece of genius from Warren Buffett's longtime partner, Charlie Munger. The real magic in investing, the eighth wonder of the world, is compounding, letting your money grow on itself over long, long periods of time. And that one catastrophic mistake that we've been talking about, well, that is the unnecessary interruption. The single best thing you can do to get rich slowly is to simply avoid the one giant mistake that kicks you out of the game for good. So when we put it all together, what does it really look like? This chart sums it up beautifully. Sure, bad luck and external shocks, things you can't control, they definitely play a role. But look at the big picture here. A full 80% of these massive mistakes come from internal, controllable factors, thinking you're too smart to fail and letting your emotions get the best of you. And you know what? That's actually great news, because it means the biggest risks are the ones we can actually do something about. So here it is, the most important takeaway from all of this. After looking at all of these titans, the ultimate lesson is that investing isn't about being right all the time. Nobody is. It's not even close. The game is about survival. It's about setting up your process so that you can survive your own mistakes and avoid that one single catastrophic error that you can't ever come back from. And that leaves me with one final question for you. We've just seen that the smartest people in the world, with all their brain power and all their resources, still fell into these exact same traps. It's a pretty humbling lesson. So the question isn't if you'll make mistakes, it's how you prepare for them. What's your process? What are your rules? What is your margin of safety?